Good morning, everyone, and welcome to the MFSA's virtual workshop. We really look forward to the presentations today and all of the information that we are going to share with you. Let's look at the program of the day and the purpose. So the purpose of the workshop is to provide an overview of the microfinance landscape and offer you valuable insights. So I think in this specific workshop, we identified areas that is really crucial now: debt counseling, debt collection, FIC, rates and fees, and all of that information is very, very important to share with you. So this is the welcome and opening. Then we've got service provider videos. And you can also read through all of the programs and the speakers: debt counseling, Benay and Reinhard, debt collection, Marius Jonker. The FSCA will be giving us an update. Then also we have Jan Augustijn from FIC that will be talking about FIC risk and compliance reviews. Then the NCR, Mboniseni, that will be doing a presentation specifically on investigations, interpretations, and compliance. And I think for the final bit, we have Brett van Aswegen, also a board member of the association, that's going to talk about South Africa's financial exclusion crisis. You know, what is the problems that we have? Why is there a financial exclusion crisis? And what influence does the rates and fees have on this financial exclusion crisis? So if you stay for everything, please also remember to stay for this part. I think this is very important, as we know the rates and fees reviews are up for review next year. So first up in the program, we have a video by MicroMax, and we want to welcome all of you guys, and we really want to thank you for your support.
In the ever-evolving world of lending, success hinges on one critical factor: efficient loan management. Welcome to Max Money, powered by MicroMax, the game-changing loan management software as a service solution that has been transforming the lending industry for over 33 years. Are you ready to streamline your business, reduce capital costs, and optimize your loan management performance? At MicroMax, we understand the challenges you face, which is why we've developed Max Money, a cutting-edge loan management software as a service solution designed to streamline every aspect of the loan cycle. From seamless onboarding to efficient pay date management, collections, and more, Max Money is here to empower your lending business while keeping regulatory compliance in mind. Our streamlined loan management. Max Money simplifies every facet of the loan cycle, providing you with the tools you need to succeed. Our robust accounting backbone empowers you with valuable insights, facilitating informed decision-making. Make data-driven decisions with our comprehensive reporting features. Through strategic partnerships with leading payment integration providers and credit bureaus, we offer a comprehensive ecosystem that elevates Max Money's functionality and efficiency. But Max Money is not just a software solution, it's a partnership. We offer unrivaled support and industry-leading uptime. Our remote support strategy ensures you receive assistance whenever you need it, ensuring uninterrupted operations, secure processes, reliable follow-up, and improved risk control. Power up with Max Money's modules, each designed to take your lending business to new heights. Max SMS is a messaging platform for bulk communication, OTP authentication, and client retention. Our Max Media module offers risk mitigation features like time-stamped photos, non-repudiation, and robust security. The MaxMail module is a powerful email platform to increase engagement, improve customer service, and boost sales. MaxUp is our upselling tool to enhance value, increase revenue, and ensure retention to microfinanciers and ecosystem tech partners. Max Collect, our module to efficiently manage collections and delinquent accounts to boost recovery rates. Are you ready to unlock new opportunities? drive innovation, and optimize your business's performance and profitability while reducing capital costs. Let's discuss how our solutions can specifically benefit your organization and enhance your financial operations. Max Money, powered by MicroFinance. Rethink efficiency, compliance, and success. Elevate your expectations with Max Money.
Thank you very much. That was a video of Max Money. And first up, I would actually like to thank all of our sponsors and our service providers: Amplifin, Akpas, Altron, Anchor Point Risk, Akiba Digital, DC Credit Protect, Groups Are Us, Experience, Share Systems, Akpas, Aspis, Micromax, Universal Insurance, TransUnion, and SureCard for their support. I think with all of these videos we are showing you guys, they definitely have solutions for you. And as we go through the program today, a number of these service providers actually speak to the following problems. So we are going to start off with a very, very interesting discussion. And we have representatives here: Benay Sager, he's the executive head of Debt Busters, and Reinhard Plettenberg he's the president of DeCasa. So debt counseling in the industry is definitely a contentious subject. There is a place for debt counseling that works well, but we also know that some of our members are facing difficulties with regards to debt counseling. So let's maybe get into the presentations. And as you have questions, please type them in the chat box. I'm going to see if we can answer as many questions as we possibly can. But if we don't get to answer all of them, we will also revert them to Benay and to Reinhard, and we'll take it from there. So first up is Benay. Thank you so much for being here today, Benay, and for talking to our members about the debt counseling industry and what's happening in the debt counseling industry.
Thanks, Leonie. I just want to make sure everyone can see my screen.
Yes, we can see your screen.
Okay, great.
Yes.
Great to be here. Thanks for having me. I'm gonna actually spend time on only one slide. Today happens to be the day we Debt Busters release our debt index, which is quarterly. And today happens to be the one today actually. To look at Q1 2024. So we're looking at the freshest data, so to speak. And I just want to spend about 5 minutes talking through what we're finding with regards to that. So, and like I said, it's only one page. I think to start off with, first I want to say 2023 was probably the hardest year when it comes to, financial situation for South Africans in the democratic era. We've had a lot of interest rate increases over the last year and a half, as you know, 475 basis points. And what's happened is that along with the high inflation, particularly food and fuel and electricity inflation, it's really eroded disposable incomes. And I think in 2023, it feels like a distant memory. We haven't had like a month or so of load shedding. And I know everybody's quite suspicious about why we haven't had it. We're not getting into that discussion. In 2023, we had a lot of it. And I think even in early 2024, we had a lot of it. So all of those things cost money in terms of businesses, especially the people who are on this call. It costs us and consumers a lot of money to try to put in place mitigation plans, whether it's your house or your small business. And I think it's taken money away from what ordinarily people might have in terms of disposable income. So against this backdrop, what we've seen is consumers continue to try to be proactive in managing their credit and then making sure that they deal with, when they get into a difficult situation. So in Q1 2024, we saw increased demand, about 22% compared to the same period a year before. So that's Q1 2023. And then for online debt management tools, which are generally sort of like the first step in our process, but also gives anyone on this call and anyone in SA can sign up to the website. Doesn't mean you're signing up for debt counseling, but it allows you to get a view on your debt profile, on your credit profile, on how things are working or not working, and it's got some proprietary tools. We saw that go up by 30% compared to the same period last year. it's a great way of measuring it because it just shows intent in terms of people wanting to see how they improve their finances. So having said this, for the first time in a while, we see that the median debt to income ratio is kind of stable for 3 quarters in a row. It's been around 106, 107% debt ratio. While it's still elevated, if I can remind all the listeners, a year ago, it was about 120, 119%. So we welcome this improvement. I think it's a good sign that the overall absolute debt levels have come down a little bit. But at 107%, it's still too high to our liking. And I think we're seeing this, as a byproduct of the interest rate increases and all of that. We saw that pretty much all consumers who applied for debt counseling had a personal loan at the time of application. About 25% of them had a short-term loan. I think both indicating that people still need access to credit to make sure that they can provide the necessities. And when we ask consumers, why do you borrow? It's mostly for necessities. So compared to 2016, some numbers, the people who applied for debt counseling in Q1 2024 had the average incomes had grown by only 1% over this 8-year period. But inflation in a compounded way is 48%. So that's quite substantial in terms of the impact. And if you can think about it, that means in a way we have almost 50% less disposable income compared to what we did a few years ago. And it's not just me saying it. I think pretty much all of us on this call probably feel it. That's the first point. The second point is that the debt service burden is still too high to our liking. People, consumers still need to spend about 62% of their take-home pay to service debt. And of course, I'm talking about people who apply to debt counseling. So there is a selection bias here. We accept that. But when we look at the different income bands, we see that those with higher take-home pay are needing a lot more of their income, 69, 70%. In terms of a month-on-month basis to service those debt repayments. It's a lot. Maybe we can do it for 1 month, but you can't do it sustainably. And again, sticking with the highest earners brackets, their debt levels are far more elevated compared to what they were a few years ago. Again, supports the point that, they are supporting a number of different people. And, it's 172% in terms of debt levels on unsecured debt compared to a few years. That's substantially higher than the inflation over the period. And I think the last point here is in terms of the findings, is that for those higher earners, it's, their overall debt levels from unsecured debt are 41% higher to what they were a few years ago. And I think we need to, again, consider this in the backdrop of salaries not increasing, but interest rates increasing. To put it into perspective, on average, the bonds that we see used to be 8.3% per annum in terms of what we saw on the balance, certificate of balance. Now we see that they're 12.3%. And for a typical home loan in South Africa, which averages around 1.4, 1.5 million rand, that is 4,000 rand exactly, 4,000 rand extra per month that the consumer needs to find from somewhere. And I can assure you that many of the consumers just don't have that kind of extra cushion when they took out these home loans. And I think we also see that the average interest rates for unsecured debt is also going up substantially. A few years ago, it was about 20%. Now it's 25.7%. So, I think it's important to keep these things into perspective. People who come to us, one pleasing note is to say the number of people graduating, paying back, has grown by tenfold in the last 8 years, which makes all of our staff smile. And to the extent that those who finished in Q1 2024, during the course of their debt counseling period, they paid over 600 million rand. So I want to point out that to your earlier point, Leonie, debt counseling is a long-term process. It's not for everyone, but for people who need it and who stick to the plan, it actually pays for everyone involved. You get your money back, your members rather. Consumers are happy because they can get into a restructured debt repayment plan. And again, these are consumers not avoiding their debt, which is far worse, if they were avoiding their debt, bury their head in the sand. And I think it works for the economy because they get reintegrated back into the borrowing sphere. So I think I want to pause there. If there's any questions, I'm happy to answer them with regards to the data, but I'm going to hand it back to you, Leonie and Sinay.
Great. Thank you so much, Benay. I think before we start, with any questions, this was very informative for me as well. Reinhard, let's maybe get into your presentation and then we take it, as a whole. I've already received on my WhatsApps a lot of questions. So if you don't want to put it on the chat, I'm going to put in my cell phone number as well, and you can send it to me as well so that we can raise the questions. Good.
Okay, good morning, everyone, and thank you, Leonie, for inviting myself and Benai onto this platform. And it's nice for us to actually be able to sort of speak to everyone and just give you an idea of what's happening from our side. Now, I mean, we have spoken on numerous occasions, so I think today I'm just going to look at the problems that we are facing from both sides. And let's face it, our two industries haven't always got on the best, but we certainly want to sort of look at some way that we can sort things out. So what I'm going to look at right now is, first of all, the complaints that we've been receiving from the debt counseling side, and if we can just go through that. So the first point is refusing to accept an account under debt review. Right now, obviously, from Section 86(5) of the National Credit Act, when you do really have to accept an account under debt review. You can't simply sort of turn around and say you're not going to accept it because it's only a month old. So just bear that in mind, that although you might not accept with the actual terms and what we actually present to you, that you still need to accept the account under debt review. And then the next point is not responding to a Form 17. Now, the things here, by not responding to a Form 17, the debt counselor is allowed to actually use the balance given by the consumer themselves or alternatively from the credit bureau. So you're putting yourself at risk by not responding to the debt counselor. So please, it is important that you do respond to us within those 5 days. All right. Then the next thing is refusing to cancel or refund debit orders. Now, the problem here is it causes a massive knock-on effect, because obviously we send our proposals to all the consumers out there, credit providers, and next thing, if a debit order is struck and there's no refund, it actually puts the entire plan into jeopardy. And quite often we can end up having the accounts terminated, and it becomes a huge task for us to get everything reinstated. So please do work with the task agreements that are in place. And one of the things I've got there on the task is when we send DCRS proposals, quite often they are refused. And I know MFSA have signed up to the task agreements, but I'm sure there's something that we can do to discuss this further. But guys, we need to speak to each other, right? Instead of just sending mails, etc. So if we just have a look at the complaints we've received from the microlendings about us debt counselors. Right? You tell people to take out a loan to pay their DC fees before entering debt review. Now, I don't know where this comes from, but just to let you guys know, when a person signs up for debt review, we will generally have everything put together prior to us actually receiving the first payment. So basically, we'll get the COBs, we'll then do our assessments, whether they're over indebted or they're not over indebted, send out proposals, and then in a few weeks later, do we only receive the first payment? Because the client has anything up to 45 days to make their first payment to the debt review process. All right. Discrepancies between your budget and that of the debt counselor. Right. I'll speak about that in a little more detail in the next slide. So, but we know what the problems are there. And then sending a Form 17.1 and a 17.2 on the same day. Right. I mean, a debt counselor cannot send out a 17.1 and a 17.2 on the same day. I mean, you've got 5 days to respond to our 17.1 with a certificate of balance. And only after that can we actually sort of send you out the 17.2 confirming that the client is over indebted or not. So if you do receive a 17.1 and a 17.2 on the same day, just don't accept the 17.2. And then telling your clients to change their bank accounts. Right, so this has been ongoing backwards and forwards, but once again, when credit providers refuse to refund debit orders or sort of do grab payments from a client, we can see why we're telling people to change their bank accounts. And I think it's important that we actually speak to each other to sort of try sort things out and to ensure that this doesn't happen. Okay. And then the other point is you are accusing the lender. We're accusing you guys of reckless lending, and then you're failing to get a response from the debt counselor. And this is a further loss of 1,500 Rand by the client, which I'm quite sure does frustrate you, especially if you don't receive any sort of responses. However, there are set processes behind this, and so they do need to get back to you. So if you do not get a response, please bring this to the attention of the castle or bring it to the platform with at MFSA, and they will bring it to our attention, and then together we can take this up with the National Credit Regulator. Okay, so just move to the next slide, and let's just have a look at the reality that we live in today. All right, salaries are not in line with inflation. There have been sharp increases in the basics, your groceries, your fuel, electricity, water, ongoing unemployment with no clear outlook. Then, and then if we have a look at what's happening around, I mean, the South African post offices and the mining industry have indicated further large-scale job losses. And the political uncertainty, which is with our elections looming right now. So all in all, it's certainly not the rosiest of outlooks. So we need to work together for the betterment of all. So the next thing is, so how can we help and address these issues together, right? Respond to requests from both parties in a civil manner, right? Really, we need to speak to each other, pick up the phone, speak to your debt counsellor, speak to the debt counsellor, and vice versa, right? So rather than fight with the debt counsellor from the onset, see what the problem is and what is being offered. Okay, and now if we sort of go on to the discrepancies in budgets, let's be open with one another. I mean, clients, I mean, do have a tendency to hide their expenses to ensure that their loans are approved, and when they come to us, we have additional expenses. So let's just look at things together. You say, listen, this client said this is what's been given to him on expenses, and this is what we've got. So let's speak together. And if a client is lying, then you can sort of you've got protection. So that's why I'm saying when you sort of do your budgets, make sure you include all loans listed on the bureaus together with their listed expenses, and make use of Regulation 23, and you will not fall foul of reckless lending. Good. So now, as both debt reviewers associations and MFSA have a good working relationship, please make use of their platform to voice your concerns, as this will allow us to work together to have them addressed. Right. However, we can only act against our members, so DCASA and NDCA. So if your client is struggling, so therefore we would suggest that if your clients are struggling, insist that they use a registered debt counsellor with the National Credit Regulator. Recommend the use of an association member such as DCASA or NDCA, and then ask them to make use of platforms such as Hello Peter to see who they're dealing with. I cannot stress this enough. You really need to, these people need to look at what they're sort of getting themselves into. And finally, when we are aware that the industry faces numerous issues, and we believe the way forward for now would be that all debt counsellors belong to an association, eventually leading to an establishment of an independent body that will be able to hold their members to account. But as this lies with the NCR and the DTI, we can only request that these changes are made. So for now, let's look at working together in the interest of both our clients. Thank you very much.
Thank you so much, Reinhard and Benay. I think this issue of debt counselling is concerning to the industry. And we know that our members are facing a lot of problems, specifically with regards to debt counselling. I think what is very exciting for me is to know that Timmy van der Gryp, who used to be in the debt counselling department at the National Credit Regulator, is actually returning back to the National Credit Regulator in the debt counselling department itself. So I feel that, immediately there would be somebody that we've always talked to at CIF and that has dealt with our industry concerns. So that is something that the industry, the debt counselors and the credit providers are excited about, the fact that he's returning to the NCR. All of these issues and concerns raised, Reinhard, is also in the MFSA's debt counselling booklet, and that was actually drawn up by Timmy van der Gryp to provide our members with some guidance. So I have posted a question in the chat box. So let's start with that one. with regards to can debt under debt review prescribe? A person goes under debt review, we get no payments after 3 years, they get a call to say the debt has prescribed. So Reinhard and Benay, what is the process of this to be followed? Because this can also be abused by the consumer to simply just not be responsible for their debt.
Yes, I mean, unfortunately, if a client does come on a debt review and doesn't pay, just bear in mind we as the debt counselors do not get paid, and obviously the credit providers don't get paid. The debt will unfortunately prescribe after 3 years. So if you want to prevent that from happening, either need to take legal action to get a sort of something in place on that, and then obviously that cannot prescribe after that, or make sure that the client makes a payment within that 3-year period of some form, then because that brings it out of prescription. But that's the
And
only thing you can do.
how many payments do they have to miss in order for our members to take legal action? Is it 3 payments?
I mean, at the end of the day, as soon as a client is in default, there's no reason why you can't take legal action. However, taking legal
Immediately,
action, yeah, but taking legal action costs a lot of money. So, and
yeah.
especially when you want to get a judgment in place. So it's about juggling. Is it worthwhile taking the legal action, or would you be able to collect something and to sort of ensure that the account doesn't prescribe within that 3-year period?
I think a concern from my side is that Capitec article that came out in last week, where Capitec actually stated, that out of the 12 billion rand of their bad debt, 4.1 was due to, debt counseling not working and consumers not repaying. So obviously there's a trend in the market of consumers abusing the system, going under debt counseling, and credit providers, this contributing to their bad debt. Benay, what would your guidance be for credit providers in order to make sure that they do collect on these installments?
Yeah, Leonie, I think we also need to recognize, just comment on your point. I think there's a lot of consumers who would ordinarily not pay, whether they are in debt counseling or outside. I think we mustn't confuse the two, that those people would probably still not have paid, whether they are in debt counseling or not. So I don't think, the root cause of some non-performing debt is all of it is debt counseling. So I just want to separate that. I think we need to recognize that there's a big universe of 10 million consumers who are in arrears in South Africa, and a tiny portion of those are in debt review. So with or without, I think the consumer is under severe strain, and behaviors don't really change. So I think I've seen some questions asked here. I think the most important thing is to make sure that, like, the collection mechanisms that the debt counselors have, that they've actually got strong systems, and they've got teams of people that are focused on it. In the end, like Reinhard says, debt counselors' fees are tied to the success of consumers coming to clearance. So is the PDA, so is everybody else. In the end, I think, we need to see that in the long term, if the debt is paid, that actually helps everybody. Now, so having said that, I do understand your predicament in the sense that you had total control over this consumer in terms of how you interacted with them before they applied to debt counseling. And when that happens, you have zero control as a credit provider. So that is a tough spot to be in. And I think what we need to work out is that there are a number of, there are a number of debt counseling companies and debt counselors. Some are good, some are not as good. I mean, just like any other industry, and just like I assume some of the people who are on this call, you would deem some of your colleagues to be better at doing what they're doing than others. And I think over time, it's up to all of us to educate the consumers about where to go to get the right service and the good service in our industry, whether that input is coming from your members or mine. And over time, one would think that people vote with their feet, so to speak, that you can actually, eliminate some of the more sort of ineffective entities that are out there when it comes to collections. So, I think it's a tough one to answer. In the end, we all want clients to pay, but we also recognize that there's a lot of other factors that happen, and life happens. And nobody is in full control, to be honest, when it comes to the process.
No, I completely agree, and it is a tough question. And um, in the end, if the consumer doesn't want to pay, if he's under debt counseling or if he's not under debt counseling, he's not going to pay. So that's definitely a consumer behavior problem. I think, Reinhard, what was also very interesting for me to see is in the reckless lending investigation processes where, the debt counselors send this letter of, reckless lending. Um, our members don't have a problem to complete the documentation. I think just the way in which, some credit providers are almost blackmailed to write off the debt. And if they do submit the documentation and they get no feedback, it is obviously important for our members to get some feedback. So is there an escalation process where we can send this to say, we haven't received any feedback, from the specific debt counselor?
Yeah, the only person that you can really send that to, if they're one of our members, then certainly send it through to DeCasa. However, it is the NCR that need to actually take this on. But when we're talking about reckless lending, I mean, you've got Section 23, which pretty much covers you on most aspects. And as long as you've actually listed all the debt the client has, and then taken into account what they claim they're spending on a month-to-month basis. I think we had one recently where the client was single, didn't have any dependents, and then it comes across to me and they've got 7 dependents. So there's a huge discrepancy, but the lender hasn't done anything wrong. The client has lied. So it's in that case, it's not reckless at all. So that's why I'm saying let's speak to one another, because we always see these discrepancies in budgets from what one person tells the lender and one what tells the debt counselor. So, and if we sort of turn around and speak to each other, I'm sure we'll be able to resolve a lot of these matters quite quickly, because we'll go back to the client and say, listen, you've lied. There is no reckless lending here, and we can take it on that basis.
Yeah. No, I completely agree with that. Yeah, it is a difficult one because sometimes, our members that nobody wants to be on the radar of the NCR. And, immediately there's some kind of that blackmailing is we're going to report you to the NCR. But it's good to then refer these, questions and complaints to the association and also to the National Credit Regulator, because we all know, like with microfinanciers, there's the legal ones, there's the registered legal ones, but illegal ones. But I think, to bring it under the attention of the NCR is very, very important. Let's go to some of the other questions here. I think there is a major concern with these, debt counselors that phone consumers and don't educate them specifically about, the process of debt counseling. So consumers go under debt counseling and they are not aware that they can't get access to credit for the next 5 to 10 years. Benay, maybe some advice for credit providers and for consumers to say, what do you do in instances? What is the kind of questions that you ask? And maybe for the association, what can we do to educate these consumers and credit providers? Because there is a place for debt counselors that does these telephonic interviews, but when the consumers are not informed, it becomes a problem. I think you're on mute.
Yeah, I happen to be the first person to be told I'm on mute today. So 4 years in, we're still learning how to use this. We actually had an article not too long ago in a few of the publications, the National Debt Counseling Association, talking about how do you actually find, how do you distinguish, dodgy versus legit debt counselors. In the end, like, everybody's a debt counselor in terms of registration with the NCR. And I'm sure the NCR is probably also on this call. So this is not to say I'm talking ill about them at all, but I think that registration is a given. I think, if you are getting a phone call from somebody, just like you might be getting a phone call I get a lot of phone calls about a lot of other things too, by the way. There are lots of scams out there running the whole gamut. There's someone selling me Bitcoin and there's someone selling me insurance and there's people selling all kinds of things. I think it's important that for an individual, if you feel that it is someone that you want to talk to, ask to call them back. Ask them, what's their number. You can call them back if you from a phone perspective. Ask to see, whether you can go visit them in their offices. If they say no, you already know there's something that's not quite right. Ask them, which PDA they use. Ask them, what's the DC code, what's the debt counselor's code, and so on. There's some things that you can do for your own verification, and ask to call them back at your own time, if you do want to proceed. I think for some people, it's a great avenue to get, exposed to some things that they wouldn't necessarily be aware of. So, otherwise, but at the same time, as a consumer who's savvy, in South Africa, sometimes people can be a bit too trusting. Just make sure you establish the identity of the entity that's calling you, and you feel comfortable before providing any personal information. And I would say, those are sort of the type of steps that one should take.
Great. No, thank you. I think, from the association side, maybe also we should update our consumer education material that our members can put in their offices, because I think it's fair questions to say, can I come and visit you in your office? Can I come and see you? Because immediately if they say no, you obviously know that there is a problem. Then Marinda also said DCs also advertise their services as debt consolidation. We need to educate consumers that debt counseling is not consolidation. And that is definitely something that the association should look into as well. Then, with regards to debt counseling, how is the associations, Benay, you and Reinhard and them, how are you guys dealing with the illegal debt counselors, the debt counselors that are putting people under debt counseling, but that are not necessarily registered with the NCR, or that are registered but are not doing it according to the processes? Is there something that you guys are doing from your association side to report them? And is there a way that the MFSA can also contribute to this? Because we've received a list of, unregistered debt counselors that are trying to put people under debt counseling and, collecting money from them, also not putting it through a PDA. What is the process that can be followed?
Okay, if I can just step in there very quickly. Recently, we did have a member that did contravene our sort of ethics codes, and when questioned, they opted to rather leave the CASA itself than to be sort of scrutinized any further. So, and obviously that has then been reported up the line, down to the NCR, because at the end of the day, we cannot actually take any sort of legal action against these people, but we can kick them out of our association. And this is what we intend to do, and this is why we say we really need help from all sides. If you're going to go to a debt counselor, you should really look at sort of finding somebody that's working within an association, because you can report them to us, we will investigate them, and we'll take matters further if necessary. So I think that's certainly one way of looking at it.
Yeah, because obviously before maybe Benay, your inputs?
Yeah, I would also add, I think that the topic we were discussing earlier, in the end, we have limited powers as an association, like Reynard says. You terminate the membership. But I don't have, from an act perspective, we are not the regulators. The regulator has certain powers. And I think it's important that these kind of things are brought to the attention of the NCR when they happen. We have certainly shared list of what we believe are not great practices, or DCs who don't really adhere to great practices with the NCR a number of times. And I think, like I said before, we try to educate our own consumers with sort of press releases and the like about, how to look for the right sort of fit in terms of a debt counselor. But in the end, if we all feel like some entities are operating outside of the norms of the industry, over time, you have to educate consumers about who those entities are. And then people, again, hopefully will vote with their feet, so to speak, over time, that the business kind of trickles away from those entities. And then, they won't survive. I think that's the best way to think about it. It's a long game, but, unfortunately, I don't know that, there are many other options.
No, I completely agree. And, debt counseling is in the National Credit Act. And, like you said, there's definitely a role for debt counseling to play if it's done in the right manner. But like any business or any industry, there is people that are going to take chances. And it's just the way in which we handle and escalate these matters. And it's good for me to know that the associations has got, like a conduct ethics code. And if they don't comply with this ethic code, you actually eliminate them from the association and you report them. So this is also something that the MFSA will take into consideration. And we've got a good relationship with Benay and with Reinhard. And if you have any questions, if the members ask questions, please escalate it to the association so we can talk to the different associations, because we really have good working relationships here. As in any industry, there is some debt counselors and credit providers that will take chances. Reinhard, Benay, thank you so much for your time. We really do appreciate it. Thank you for sharing, and we will definitely, stay in touch, and I will see you in the CIF meetings going forward.
Lovely,
Right.
and thank you very much.
Thank you.
Thanks.
Next, we have Eddie Srief, the Chief Sales Officer of DC Credit Protect, who's going to do a presentation. Welcome, and we look forward to your presentation.
Great. Can you see my screen?
Yes, we can see your screen.
Fantastic. Great. Thank you very much, everybody. It's quite fitting that I'm speaking just after the debt counselors, because that's really where DC Credit Protect started. So DC Credit Protect, as an introduction to the industry, we specialize in credit life insurance. And we specifically, as I mentioned, started in the debt counseling industry. So Reinhard and Benay knows me very well, and our company. And we thought that it's time for us to spread our wings and to move into the microfinance industry, and credit providers to provide our products. So a little bit of history about ourselves. We were established in 2019. And as I mentioned, specifically providing credit life and other insurance-related services to credit providers, to benefit their clients and to protect the credit providers. Credit life really is there to care for the credit providers and to make sure that they don't lose their income should a client be retrenched, disabled, and a worst case scenario, pass away. Yep. So we believe really in building and maintaining very good relationships with our clients, the credit providers and their clients. Really committed to servicing our clients properly and rendering the best services in the industry. Now, loyalty is a massive part of our ethos. Staying loyal to our clients, staying loyal to our underwriters, our insurers, which is African Unity, based in Cape Town, and building those relationships to move forward and service our clients properly. And integrity is a massive part for us. Playing open cards with our clients, our service providers, and we honor our agreements and undertakings. So benefits to the credit providers, should you wish to engage in business with us. Your market value of your company increases as you build a insurance portfolio as such with us as an FSP. Should you want to sell your business one day, that insurance component that you include there increases the market value of your property. So a really good benefit there for you. Very little time and effort is taken from you as the credit provider. We do all of the work. So we will contact with the clients, we will give advice, we handle the administration, we handle the claims process. So we take care of all the FSP work. So you really, should you engage with us, you become a lead provider to us. So we do most of the work on your behalf. Our systems are user-friendly, and we're also currently busy with integration with the loan system providers. So we already started engaging with Micromax, and moving forward, we will chat to the likes of ACPAS and all the other loan system providers to integrate with them, and just to make it easier for the credit providers to be able to supply credit life insurance for to their clients. We have various collection methods. So third-party payment providers, debit order facilities, EFT premium collections, pay at, salary deductions. So we take care of all the necessary collection methods in order to receive those premiums. Our products that we provide, as I mentioned earlier, we specialize in credit life. So your credit life, as most of you should know, death, permanent disability, temporary disability, retrenchment, and dread diseases is what is covered, and that is prescribed by the NCR. So our product follows the rules. We also provide a funeral policy and an income protector. We feel that with the funeral policy and the income protector, that product fits very nicely with the credit life. So if you do get retrenched, for instance, the credit life will cover your monthly installment for up to 12 months. But how do you put food on the table? How do you pay school fees? So the income protector, covers you for a 6-month period, 5, 10, or 15,000 rand per month, just to supplement that income that is lost, so that you can pay the school fees and you can buy airtime, etc. Funeral, exactly the same. If the client passes away, the credit provider is cared for. We will settle the outstanding balance should there be a death, but who pays for the funeral? So these two products fit very nicely in with the credit life. A bit about our team. Highly experienced team. We have 3 key individuals within our company. Over 100 years of experience for our sins. And we're really focused on retention and optimum service delivery to our clients in the industry. As I mentioned earlier, our product is underwritten by African Unity Life. They're registered long-term insurer and authorized FSP. Based in Cape Town, African Unity Life has got, I think, in excess of 3 billion under assets. So African Unity is a very strong, very stable insurance company, and we have fantastic relationships with them. So guys, very quickly from me, just an introduction to DC Credit Protect. I'm sure you will see us at the branch meetings, the round tables. We will be in person, and we can start chatting more and engaging with you guys. So please watch out, watch the space. And if they've got any questions, you're more than welcome to ask those questions now. Alternatively, myself and Ina's telephone number and email address is on the screen. If you'd like to engage with us, please feel free to contact with us. Thank you very much.
Thank you so much, Eddie. Thank you for sharing the information. Yes, Eddie and his team, are service providers of the association, and they will also be at our roundtable sessions. So please make sure that you do contact them if you have any questions. Okay. Next, we've got Marius Jonker. He's the CEO of the Association of Debt Recovery Agents, and he's going to talk about debt collections and an update on debt collections. So I think, debt collection is very important to our industry and for our members to collect on their bad debt. So Marius, I'm going to hand over to you, and thank you once again for, giving us the time in your diary, because I know you are a busy man. So we look forward to your presentation.
Thank you, Leonie, and it's always a pleasure to meet with the MFSA members. I think we're in the same industry, and in a lot of respects, we're in the same boat. We deal with the same challenges every day. And your challenges becomes our challenges, and vice versa. Before I jump into the topic of discussion, I had a request from Leonie to just give a quick update on emoluments attachment orders, and there's a request on exactly what progress is being made in having a standardized process in the various courts, as each court seem to apply their own rules. Unfortunately, we cannot make progress there. We've dealt with and met with the Department of Justice, with the Magistrates Commission, with the Rules Board that drafts the Magistrate Court rules, etc. And everyone's attitude is that it's a cornerstone of the legal system, that there has to be judicial discretion. And the magistrates, to a certain extent, have their own discretion on in certain procedures. So each court district issues practice directives, for example, on what documents you need to file, for example, and does it have to be the originals, or are copies okay, or can you submit an affidavit stating that you're in possession of the contract, etc. Those procedural aspects cannot be standardized, and Department of Justice, the Magistrates Commission and the Rules Board are very adamant that they're not going to prescribe to magistrates and infringe on the independence of the bench. So unfortunately, that is something we're going to have to live with. Okay, then, you know, normally we talk about compliance, and compliance becomes a bit monotonous, and I thought of rather speaking to you on what you can do to optimize your collections. I, on a very regular basis, get telephone calls from MFSA members or from the MFSA office with a request from a member, and the request is normally to the effect that, you know, I need a new debt collector. Who's the best? Who can you recommend? I'll just touch on that briefly in a moment, but I think the first question you have to ask yourself is, do you have to outsource your debt collection, or is there a possibility of selling your debtors book? Amongst the MFSA members, for some or other reason, we don't see a lot of sales of debtors books. It is very common in the banking industry, the retail industry, the mobile network operators industry, and various other industries. But MFSA members very seldom sells debtor books. So your first question should be, are you going to outsource your debt collection work through agreement with a debt collecting company, where you remain the creditor, you remain the owner of the debt, and you enter into a commission agreement with a debt collector? Or are you going to sell your debtors book? Where you sell a debtors book, the buyer becomes the credit provider, takes over all your rights and all your obligations in that debt, and you basically have no further concern with that debt. If you can move to the next slide. Okay, firstly, where you require the services of a debt collector to whom you want to outsource, I cannot recommend an individual debt collector. The same as what Leonie cannot advise a consumer on which microlender you should use. What I can do is to advertise your need for a debt collector amongst the ADRA members, and it is then up to those members to contact you, or for you to contact the members that shows interest. And for us to do that, we just need some basic information from you. For example, what's the legal nature of your debt? In your instance, it will be unsecured lending in terms of the National Credit Act, an indication of the volume and value of accounts, the frequency of handovers, how often do you hand accounts over to a debt collector, and then if you have any specific instructions, for example, if you only want legal action to be performed on your work, or if your client base is limited to a certain geographical area, etc. We just need that basic information, and then obviously your contact details, and we can circulate that request amongst our members, and the members who are interested in dealing with you can then contact you. Next slide. There are various advantages to selling a debtors book, and as I said, I don't see that happening often amongst MFSA members, but it is something you should consider. Firstly, if you sell a debtors book, you get an immediate cash flow or cash flow injection. You don't have to wait for a debt collection process that can take months or even years. And then it's also dependent, your income's also dependent on what the success rate is going to be in collections, etc. So the operational risk passes to the buyer as well. It is not your risk anymore. All the expenses that has to be incurred, for example, if there's legal cost incurred, the cost is for the buyer, not for you. And similarly, if there should be a cost order granted against the creditor, that cost order is for the buyer. You're not a party to any debt collection process. If legal action is to be taken, you're also not the plaintiff in that matter. The buyer of that book debt becomes or steps into your shoes for all practical purposes. Because of that, you also, as a credit provider, you distance yourself from any enforcement action, and I think that diminishes your risk amongst your client base as well. I don't think it creates a very positive reputation for a microlender or any credit provider to be seen to be litigating against their own clients, enforcing debt, etc. As I mentioned, the risk of no recovery or a low recovery rate or protracted recovery passes on to the buyer as well. You get your money up front, whatever that percentage of that debt of that sale would be. If it's 10 or 20, 50%, whatever the case may be, you get your money up front. And then you obviously also don't have any further management and administrative function. For example, you don't have to monitor progress in these matters, provide your debt collectors with instructions, the continuous communication between a debt collector and the instructing client, that falls away. You don't have to provide statements to your clients anymore. They aren't your clients anymore. Similarly, you don't have to update credit bureau data, etc., etc. So effectively, your burden ends. Everything passes onto the buyer, and it is then for the buyer to comply. Obviously, the buyer of credit, in terms of the National Credit Act, must also be a registered credit provider, and all the obligations which you had as a credit provider passes onto that buyer. So yeah, I think it is not just an immediate cash flow injection, but it also ends all your continuous expenses on those accounts. Next slide. As I mentioned, not up to now, but in the past, we saw only larger corporates, banks, national retailers, etc., selling debtors books. And then also, they normally only sold debtors books once a year or every second year or so. And it was massive debtors books, several $100 million worth of debt sold in one sale. But over the past decade, we've seen sellers of debtors books sell on a much more frequent basis. Every 2 or 3 months, the same company will sell whatever debt they accumulated over that period. So it is in much smaller chunks, and on a far more frequent basis. Because of that, also, we saw a lot of new entrants, debt collectors. There's a lot more debt collectors that purchase debtors books. And also, there's a lot more smaller entities selling smaller debtor books. So that happens on a continuous basis now. And You can obviously sell a debtors book at any stage. Also, one of the questions pop up. Nothing prevents you as a credit provider. There are certain other industries, such as in education and healthcare, where there are certain restrictions on the sale of debtors books. But in your instance, there's none that I'm aware of. So you can sell a debtors book at any time. One of the factors which determines the value of your debtors book to a buyer is also your age analysis. A decade or so ago, debtors books were normally sold from 24 months onwards, and very often 2 or 3 months before it prescribes. Those days are over. We now see debtors books being sold on average from about 90 days. And people are very hesitant to purchase debtors books that are older than two years, obviously because of the prescription issues. Also, the time delays in courts to process matters to try and prevent prescription, etc. So the sooner you sell your debtors book, the higher the value, because the more recoverable that debt is considered to be. There's obviously a process involved, and that process culminates in a contract between you and the purchaser. And but prior to that, there will be a form of call it an audit by the purchaser to determine the value of that debtors book. It's compliance. Compliance is a very big issue. As I stated, the purchaser takes over all your obligations. So the purchaser doesn't want to be exposed to potential compliance issues which originated prior to the purchase of those of that debtors book. So they will definitely look at the form of your contracts. For example, is it compliant? Is the paperwork available? Are contracts available? Affordability, as you know, that's obviously a big issue, and the risk of reckless credit, because the consumer retains all rights the consumer had prior to that sale. So the purchaser has to defend himself and be in a position to defend himself should there be any allegations or defenses raised of reckless credit, etc. Prescription, exactly the same. In duplum, exactly the same. And all the other compliance requirements. A debt collector will definitely investigate to determine, is this debt enforceable or not. Then also on the collectability side, they will definitely do their credit bureau checks, try and determine what is the ability of those consumers to pay, what the average consumer profile looks like, etc. Age analysis is always very important in that calculation. So once again, the earlier a debtors book is put on the market, the better. And a debtors book can be placed on the market in various ways. I'm aware of some apps where, especially banks, would, for example, have a closed bidders group where they can place a debtors book and where you can make your offers online, etc. It can happen by invitation, or it can be a closed bilateral agreement reached between two parties where there's no advertising to third parties or potential other buyers, etc. So that process is not regulated. You can determine what works best for you. Once again, where ADRA can assist is, should you be interested in selling a debtors book, you can provide us with the basic information, and we can distribute that to the registered credit providers who are ADRA members that purchase debtors books. And I think just about everyone that purchases a debtors book is an ADRA member. I'm not aware of any non-ADRA members that purchase debtors books. So if you want to go that route, you most welcome, the same as with third-party debt collection, where you want to retain ownership and work on a commission basis, where you're also welcome to forward that info to us and we can circulate it to the relevant members and put you in touch with whomever you need to be in touch with. I think that is about my time. It's 11:05. If there are any questions, I'm happy. I saw one or two questions that I couldn't read in full. It is, yeah, on the question whether it's necessary to pre-inform your consumers, that will be dependent on your contract. There's no statutory requirement that you must inform the consumer before you enter into a sale. What we do, however, find is that will be in any event a requirement of your contract, that the purchaser will insist that you inform those consumers. What very often happens is that the part of the agreement is that the purchaser will inform the consumers, will do the administrative work, trace those consumers, send the letters out, but normally that letter will go on the credit provider's letterhead, informing the consumer that they sold the debt to whomever. Otherwise, it just creates chaos, at the later stage if the consumer says, but I don't know who this is, I never dealt with them. It does create practical problems. So there will always be a notice to a consumer.
Great. Thank you so much, Marius. Is there any additional questions? From my side, you covered mine with regards to emolument attachment orders. And then also, I think, we sent out an email campaign to our members with regards to selling of your debtors book. And there was some confusion and concern because some members didn't know that they could do that. So there was actually quite a lot of interest. And for you providing us with this information and the guidance, this really gives the credit provider some form of comfort. And I think when they are looking into a debt collection, company, I think the way in which you want to, put it to all of your members is obviously the best way. Like you said, when a consumer phones, I cannot tell them you must go to A, B, or C credit provider. Great. I don't see any additional questions here. Marius, thank you so much for your time. We really do appreciate it. And thank you for sharing the information.
No, it's a great pleasure. Thank you very much, Leonie. I hope you enjoy the rest of your conference.
Great. Thank you so much.
Okay.
Next, we have a video of TransUnion, and then we will go into presentations again.
At a time when microfinancing is gaining traction, lenders need to score more consumers better. That requires replacing analytical complexity with a single, simplified solution to accelerate credit applications. Fraud prevention, risk evaluation, affordability assessment, and precise, personalized offers are the pillars of profitable lending. This enables you to better understand each consumer and make informed decisions so you can increase profitable microfinance acquisitions. Identify potential fraud at application with enhanced pre-screening and friction-right onboarding. Estimate income using trended credit data income estimators matched against real-time income predictive models. Assess risk with industry scores per loan term product combined with alternative data scores for a holistic customer view. Evaluate ability to pay and determine eligibility for a range of offers, terms, and conditions. Successfully allocate the right product to the right customer at the right price. To learn more about how our data-driven solutions can help you lend more while mitigating risk, visit our website today.
Thank you very, very much. Up next, we have the presentation by Fatki Adams, Microfinance and Financial Inclusion, Addressing the Needs of the Underserved Communities. This is definitely something, that the association is also focusing on. And I think with the regulators in the room, the MFSA, the National Credit Regulator, everything that we are presenting on today is specifically with regards to compliance. How can credit providers be compliant, and how can we actually serve the consumers that have previously not received fair access to credit? So welcome, and yes, we look forward to your presentation.
Thanks for that, Leonie. I'm just going to bring up my presentation and share my screen. Just give me 1 second. Okay, just let me know when you can see. Okay.
We're just seeing you.
You guys are seeing me, okay. Not a bad view then, is it? Okay. Just gonna turn off my video. I think maybe it's some Zoom issues on my side. Give me 1 second. Okay, cool. So let me know you can see it.
We can still not see anything.
Still not. It says it's sharing on my side. Apologies for this, guys.
Not a problem.
Okay, it says it's loading. Apologies for this. I don't know. Zoom's not working in my favor today.
And perhaps if we can share from our
I
side,
think maybe what's that?
can we share the
Yeah.
presentation from our side?
I think, yeah, maybe let's try that.
Let's
It's
do that.
just spinning on
Perfect.
my side. Yeah. Let's do that. Apologies for that.
There we are.
And I think it's more me problem than anything else, to be honest. So please accept my apologies for that.
Great. Thank you so much. You can continue.
Okay, cool. So I think before I get into the presentation, I just want to morning. My name is Fatih Adams. I'm the Head of Credit Risk Solutions for TransUnion Africa. And again, barring the technical issues, it's an honor to be here today, and thanks for having me. So I think I just want to acknowledge all of the previous speakers. I think to your point, Leonie, I think you took the words out of my mouth. Everyone in the room today and all the discussions we've had so far are all really leading to the same thing, right? We're all in this really to help the industry, to help people in the industry. And I think to my topic today of financial inclusion and how microfinance in the broader financial services industry really plays a key role in trying to solve for financial inclusion. So like I said, we all have the same end goal in mind. And I mean, at TransUnion, our mission is to help people gain access to opportunities that can help improve their quality of life, right? I think that's the common theme I'm picking up from everyone. How we do this is by providing the most complete and multidimensional information that can help our customers make the best possible choices. And we value our customer success as well as our own, right? So that's why we go beyond just providing you guys with credit data, but we offer insights that businesses and consumers need to make informed decisions and achieve great things. Are you guys able to see the screen now? I'm getting an error here.
So we are seeing our screen.
Okay, cool.
That
That's
we are
fine.
sharing from our side. Yes.
Yeah, I think Zoom sprung into life now and gave me an error. But okay, I'll continue, and I'll just tell you when to skip through the slides, right? So
Perfect.
I just wanted to touch slightly or just briefly before we go into the meat of the presentation, the partnership we have with MFSA. So we value it again, right? And the reason why we partner with MFSA is because it aligns with our core beliefs and the values of our organization, right? It focuses on powering change and driving transformation and changing the lives of people that make use of this microfinance industry to truly solve problems that matter. So again, we're grateful and appreciate the partnership that we have with MFSA, and I myself, as well as TU, look forward to having many more engagements with you guys. So we can go to the next slide. Okay, so in the South African economy, we've seen a significant increase in the demand for finance, right? There's been a 49% increase just in the unsecured lending space. Now, this is mainly driven by your thin file customers or your new to credit guys. So these are typically your students coming out of university, looking to get some form of credit to better their lives, maybe to get some clothing for their first job or their internship. But it's also showing a high demand for liquidity in the market. And most of this is being met by the microfinance providers because these guys typically don't have access to funding or loans from the traditional banking, or maybe they can't get an account from a clothing retailer, right? So they turn to the microfinances to get that cash in hand. Now, the microfinance industry and the microfinance loan is it's a very powerful tool. and one that I believe plays a big role in fighting poverty and improving the economy of our country on a whole. Now, the unemployment rate, I think we're all quite aware that it's quite high in South Africa. It's currently sitting at 34%, and 47% within the youth sector. Now, the World Bank has noted that South Africa has one of the highest levels of inequality within the world. And again, I think that the microfinance industry can play a big role in changing that stat and changing that perception. Apologies. Can you go to the next slide? Now, I just want to make it a bit more personal, right? And take you guys on a journey and tell you a story that or an encounter I had personally. So I'm lucky enough to be based down in Cape Town. And as you can imagine, I travel up to Joburg quite a bit for work purposes and to engage with clients. And on one of the trips up to Joburg, I decided to do the whole touristy thing, and I did a township tour. And while I was on this tour, I was lucky enough to bump into a young lady named Tembi. Now, Tembi is a young lady, and she's quite sharp, right? But Tembi, like many others within her area and in South Africa on a whole, when she finished high school, she didn't have access to any kind of funding to further her studies, right? Or to get any kind of tertiary education. So what she was really forced to do was really to hustle. And again, I think this probably resonates with most of the clients that we'll deal with on a daily basis. They have to hustle in order to provide for their family and for their households. And she did this for the first couple of years after her high school career, until she built up the courage and actually got access to go to one of the micro lenders within her area to apply for funding. She was lucky enough to apply for a small loan, and she then used this to open up a spaza shop in a portion of a front room in her house. Now, this immediately gave her access to some consistent funding flowing in, and because of her drive and because of her passion, everyone heard about her services that she offered, heard about the products that she was offering, and her business started to flourish. So further than just being able to provide for her family and her immediate household, she was then also able to employ more people. And this then obviously had an immediate impact on her surroundings and her community on a whole, because those people could then go on to feed their families and to provide for their households as well. So again, you can see how the small loan she got from a microfinancer was able to have a massive impact on her surroundings. Now, Timbi's not alone in this, right? There's thousands of people within the rural areas and beyond that face the same problems as Timbi. Now, just going back to the spaza shop situation, there's more than 200. In a recent survey, we found that there's more than 200,000 spaza shops within South Africa, most of these being in the rural areas. And these are a huge source of income for majority of the people living within an area, and also provides them the services and the products that they require. But again, most of these are brought about by people like Tembi, who find themselves as part of that 34% initially, or 47% in the youth sector, to empower themselves and then provide the services to the community, as well as uplifting their households. You can go to the next slide. Okay, now before we get to the responsible microfinance, I just want to touch on the stats and the numbers, right? So, like I said, microfinancing isn't just about providing loans. It fosters economic empowerment and resilience. And for a lot of the guys that make use of these small loan amounts, it's the difference between starvation and prosperity, because they could use the small capital funding to, like TMB did, change their lives. Now, I was lucky enough to bump into TMB and have this discussion with her, but typically as one of the service providers or as the bureau, I'm not really exposed. We aren't exposed to these success stories that our partners are dealing with the clients face to face, but we do see the numbers, right? So for 2023, we noticed that there were 2.3 million new credit facilities opened by consumers just like Tembi. These are people that have previously not had access to funding to open a spaza shop, to pay for tertiary education, to pay for shortfalls in their monthly expenses, to pay for school fees. We were able to make this possible through the services and the scores that we provide to our partners in order to help the end person, or to help the person standing in front of them like Tembi. So it really does have a huge impact, the work that we do, myself and the people in this room today. Now, supporting Tembi and others just like her to achieve their dreams is what we deem financial inclusion, right? Ensuring that the marginalized populations have access to financial instruments is everyone's responsibility. And that's not just loans, it's insurance, at some savings accounts. All of these things are services that we need to provide to these people that previously didn't have access to it. But what we also need to ensure that we offer this access in a very responsible way. Not only does extending credit irresponsibly put Tembi at risk, but it puts you as the credit provider at risk as well. And that's why a proper risk assessment is essential for sustainable and responsible provisioning of microfinance to financially excluded individuals. Now, this can be a challenge, right? Because like I said, these are guys that haven't traditionally had access to any form of financial instruments, that haven't had potentially a monthly consistent income, and they haven't had jobs before. So how do you do a proper assessment on these guys? Now, that's why at TransUnion Africa, we're deliberate in our attempt to deal or our efforts to drive financial inclusion. And through that, we've developed specific products to deal with this very unique segment. So our Credit Vision Microfinance Score is an industry-specific solution that offers specific scorecards to help lenders make smarter assessments at acquisition. With improved predictive power across different loan terms, ranging from a short 1-month payday loan all the way through to a long-term loan, lenders can offer the right products to these customers at the right terms. We observed that when using these industry-specific loans, you get a significant increase in your approval rate, especially in that previously underserved population, but you also see better performance coming through, because not only are we able to approve more, we're also able to identify risk customers much better as well, and so by excluding or declining them and potentially offering them something else. Now, one of the key products that we do have for this segment of the population is what we call our CV Link score. Now, CV Link score is our pure alternative data score, which relies on purely alternative data in the forms of telco information, geographic information, and various other factors, and it doesn't require any kind of formal traditional credit history. So this is really ideal for people like Tembi that doesn't have any form of credit history that can be used for an assessment. This allows us to score more people better, and it also allows us to have an impact on those previously financially excluded individuals, and also improve the state of the economy and of the community that these people operate in. Okay, move on to the next slide. Okay, so I mean, we can't really overlook the role of technology in advancing the cause of financial inclusion, right? Like I said, financial inclusion is a major theme for TransUnion, but another theme that we've got is digital inclusion. So from mobile banking to digital payments, online application forms, the microfinance industry has the power to reach previously inaccessible populations. And by harnessing this power of technology, we can accelerate the progress towards a shared goal of financial access. Now, a lot of this was really brought about by the pandemic, right? It was almost a catalyst that threw us into the digital divide. And what we could say is that we were really digital by default, because we were forced to change our channels of application, our channels of engagement, and really the channels that our customers were more accessible to, right? Because they couldn't walk into stores any longer. Now, the reality of us embracing and adopting the convenience and the reach that technology brings us is we also open ourselves up to additional risk of fraud. Now, South Africa witnessed a significant increase of 36% in reported incidents of online banking fraud in 2022. Now, digital fraud and personal data security persists as a major concern for all South Africans. We recently did a survey where almost half of the respondents said that they were targeted by fraud schemes in the last 3 months. And 10% of them actually fell for those schemes. So as savvy as we claim or think we are, the fraudsters are quite savvy and smart as well. And it's quite compelling offers that they present to us, and it's quite easy to fall for those schemes. Now, what's even more worrying is that 39% of those consumers didn't even know that they were being targeted. Now, as a result, 87% of consumers are reluctant to share their personal information because they're worried about identity theft and privacy invasion. Now, in order to reduce this risk, TransUnion provides an industry-leading onboarding platform that takes care of all the necessary identity and fraud mitigation requirements, providing a friction-right experience. So we don't take away all the friction to make customers suspicious that this is far too easy, it could be fraudulent, but we leave just the right amount of friction so that we can still retain the credibility, right? And it's important to recognize that by trying to solve for financial inclusion and the role we play in all of this isn't the end, right? It's just a means to an end. So it's important for us to create an enabling environment where individuals have the tools, resources, and opportunities to better their lives for themselves and the communities. It's all about fostering that economic growth that is inclusive, sustainable, and equitable. You can go to the next slide. Okay, so again, like I said, it's all of our responsibilities to try and solve this financial inclusion situation that we've got, right? We play a bigger role than just providing loans and financing, but we play a role in the communities that we operate to uplift and to provide for these people, so for these previously excluded people, so that they can better their lives as well and the quality of their lives and their families. So just to cast your mind back to 2017 and bearing in mind that this was pre-pandemic, in 2017, 17 million grant beneficiaries were paid over 150 billion rand. That's almost 10% of our national budget. So this amount has increased by over 25% over the past 6 years, putting a significant strain on an already declining tax base. Now, these are people that rely on these, apologies, these are people that rely on these payouts and these grants because they don't really have any job or any kind of or form of income. So if we can make a difference to just a few people by granting them access to capital that they can then use to try and uplift themselves in the form of trading, buying, selling, but at least it's something that they could use to provide for their families and then also relieve some of the burden on the state and on the taxpayer, that would make a significant difference. So again, I just want to touch on all the talks that's happened before me and the ones that are still up to come, just looking at the themes that you guys have. I think we all have a common goal in mind, right? And I think the MFSA is doing an extremely good job of bringing us all together in the same room to have these discussions so that we can find those areas of overlap and areas where we can support each other to achieve our overall goal and our aim at trying to better the society and the economy. Thank you all.
Thank you so much for the presentation. I think, this is very, very interesting for the association and definitely a theme that we will also be driving, and that is of financial inclusion. So I think taking the rates and fees into consideration, taking everything that you have said, everything plays a role in financial inclusion. You also stated in your presentation that a lot of our microfinanciers is the first credit provider to actually provide a consumer with credit when entering the credit market. But because certain, regulations are, making it so difficult, because the rates and fees has not been reviewed, it is making it difficult for credit providers to actually take that risk. So I think there's a plethora of items that needs to be taken into consideration when we talk about financial inclusion and how this can be achieved. Thank you so much, Fatki, for your presentation. We really look forward to additional collaboration with the service providers and the industry on matters of financial inclusion.
Thank you very much. And again, apologies for the technical issues. And thanks, Leonie, for driving the presentation.
Anytime. Thank you so much. Next, we are going to have a presentation of Brenda Norton. She is from the FSCA, the Insurance Supervision Department. We've had numerous interaction with Brenda now on subjects and on different matters that they are dealing with in the FSCA as well. Brenda, welcome, and you are presenting to all of our members, and we look forward to your presentation.
Good morning, everybody. I think it's still morning. Good. Thank you so much, Leonie. I just want to firstly thank you for the invitation, as well as our previous engagements. I must say, I've enjoyed all the presentations, all the speakers today, and to Fatki's a point around, there's so much synergies, there's so much objectives that are the same, and I think around inclusion, transformation, and things like that. So I really want to thank you, and also for enriching my knowledge and my experience, especially around, credit. It really helps as well. So thank you very much for that, and thank you for the invitation. Okay, so I'll just jump into my presentation. I don't want to distract myself, so I'm just going to put my camera off if you don't mind. Is that okay? Thanks. So, Leonie, will you present or should I?
We can share or you can share. You must tell us what will suit you best.
Okay, so Sunay, if you don't mind, if you can just,
We can do that.
just
We're
do
on
that.
it.
Perfect. Thank you so much. Okay, we can move on to the next slide. Thank you. All right. So just with respect to the layout of my presentation, I'm just going to give a brief overview of our structure, our mandate, FSCA strategic objectives for 2021 and 2025, what guides our guiding principles when we conduct our supervisory activities, what the FSCA expects of supervised entities, our supervisory engagement model, the FSCA's focus areas, especially from an insurance perspective, as well as the conduct of business division, which I stem from. And obviously, just a brief overview of the consumer credit and credit life project that is currently underway. And this is how myself and the MFSA got in touch through consultation process, and which I'm very grateful for. Thank you. If we can move over to the next slide. Okay, so this is just a brief overview of our organizational structure. Our commissioner is Unati Kamlala. He has that makes up the EXCO is Fazana Badat, who's the deputy commissioner. She looks after the licensing and business center, the conduct of business supervision. Then again, we've got Ms. Ketrin Gibson, who's one of the deputy commissioners as well. She looks after regulatory policy and enforcement. And then again, we've got Ms. Esther Ludwin. She's the deputy commissioner and she looks after market integrity, retirement funds, as well as the ICT area, which is our IT area there. And then obviously we've got these supporting areas. So maybe if I can just talk to where I sort of fit in, that is under the conduct of business supervision, which is headed up by Kiriboni de Kokwe. She's our divisional exec. She's responsible for banks and payment providers, micro and payment providers, micro and excess product institutions, financial advisory intermediaries, investment providers, and then of course our department, which is Insurer Supervision Department, and the FICA Supervision. And we are then headed up, who's my HOD is Mahompi Rapasha. We consist of about 4 managers, and we've got about 6 specialists, 6 senior analysts, and 1 analyst and 1 junior analyst. So together we look after the insurer's life and non-life component. So that's just a brief overview of where I stem from. Thank you so much for that. Next slide, please. So the Financial Sector and Conduct Authority, along with our sister regulator, who's the Prudential Authority, we look after customers' interests. But they've been established as a prudential, and they look after the sustainability of, from a financial soundness perspective. We look after the customers, and obviously we've been established as a dedicated market conduct regulator early in 2018. So in terms of our objectives and our mandate, which is stipulated in the Financial Sector and Regulations Act under Section 57, which broadly outlines our responsibility and our mandate. That is to enhance the efficiency and integrity of financial markets, promote fair customer treatment by financial institutions, provide financial education, which is a big component of what we do, promote financial literacy, assist in maintaining financial stability. So that in a nutshell is, is our mandate. So we look after all financial institutions except for, your credit providers, and other providers as well. But that in itself is, it's just a broad overview of what our core function is. Thank you for that. So now if we look at our 5 strategic objectives and our scorecard and how we measure ourselves against the 5 strategic objectives. So basically is to improve industry practices and to achieve fair outcomes for financial customers. So how will we do that? We do that to ensure that, when we have these engagements, that there is actually fair principles that are instilled in the entities which we supervise. And that means obviously also creating clear conduct standards that's applicable across the financial industry, especially with regards to the COFI that's coming down the pipe. So we're gonna definitely ensure that conduct risk is mitigated across all sectors, and we're trying to definitely harmonize that as well. Act against misconduct to support confidence and integrity in the financial sector. So that is important in order. So how would we measure that? By seeing the trust that's been installed, and obviously act against scams, fraudulent, illegal undertakings, and undesirable practices, and thereby ensuring, that the financial customers definitely have trust in the financial sector. Promote the development of innovative, inclusive, and sustainable financial systems. So how would we then measure whether or not we are successful in that regard? We definitely support our partners in the BEE Commission, the FSTC Commission as well, in order to create a sustainable financial industry, and as well as ensuring that financial inclusion with respect to low income households. When we look at some stats recently, I concur with our previous presenters to say there is very little there's still very little activity or activity from the customers when it comes to insurance products and banking products. Our next objective is empower households and small businesses to be financially resilient. So this is where financial education play a very big role, to ensure that customers are very fully informed. These disclosures are being made with regards to financial products, relevant disclosures, but not only that, but making sure that customers are trained about and brought into the financial sector by making sure that they're empowered as well. So we as an organization as well, this is now our other objective, is to ensure that we as an organization also transform, that we are also responsible. So that means that we also needed to become digitally savvy in what we do, looking at different tools like the Omni CBR, which we will speak briefly on later, to ensure that we're able to look at, because previously the FSCI and previously the FSB was very sectoral. Right now we're trying to, with the Omni CBR as well as the COFI, we're trying to bring everything under one umbrella. That means that we really need to make sure that we become digitally savvy. Thank you. Next slide, please. So what are some of our guiding principles when we conduct our supervisory activities? So we need to be preemptive and proactive. What does that mean? Not only must we be proactive and preemptive, it's fine if you are able to mitigate risk that has already taken place, but we need to find ways in order to circumvent risk, and by looking at it. And this is really where our licensing department play a very big role by being the gatekeeper for us in that regard. If you look at the other principle is being intensive and intrusive. So that really means, to challenge, sometimes means to have the hard conversation with the industry, or let's say the entity which you supervise, and to challenge the strategic objectives as well as the business practices. But that also means that before you do that, you need to have deep insights in order, to challenge the status quo, as it were. And like all regulators and like all organizations, we have limited resources. So we need to apply that, circumspectly, and obviously manage our risk, but also measure the risk so that we are able to effectively drive our our activities, the tools that we use in order to ensure maximum outcome and, drive the correct behavior, especially where the risk is most prevalent and where there is a big concern with respect to customers out there. When it comes to, so just in the interest of time, the other component is transparent and consultative. So especially when we develop new rules or regulatory instruments, we make sure that the public which we service, especially the customers, especially our constituents, the entities which we service, we ensure that we consult broadly before any regulatory instrument is passed. And also, it must be outcome based. So our intention is to monitor that financial institutions are actually delivering fair outcomes to financial customers. Okay, next slide, please. Okay, it must be comprehensive and consistent. So this is where definitely COFI comes in, so that we are able to capture all activities that impact the integrity of the financial markets. So that means, a whole host of different previously entities that wasn't in the regulatory sphere. We're trying to bring them in, and of course enforcement. So enforcement is, you will notice that the FSCA, especially with respect to certain departments where we really use enforcement as a deterrent. We don't just, we don't want to use the big stick, but we want to use it as a deterrent to ensure that, to discourage conduct that leads to poor outcomes for customers. But we really try to work with the industry to make sure that we ensure fair outcomes to policyholders. And of course, we work closely with our international counterparts, such as the World Bank. As regulators, we also need that support. They provide us with training as well. And we also learn from them, what best practices are. And they also learn from us what best practices are. But we also make sure that wherever we align, that it's definitely in line with the South African markets. No, we don't just apply a blanket approach. Thank you. Next slide, please. Okay, so this is the TCF principles, and this is really what we expect from supervised entities. And I know this is very familiar to you. With regards to culture and governance, we want to see that it's really embedded across an entity, that there's suitability, appropriate products as well, and as suitable advice. The distribution channel fits the customer and the customer's needs as well. And, in terms of quality of the products itself, but then, and lastly, the post-sale responsiveness, making sure that the customer is able to claim and they're able to complain without much friction in the process, that there are no unnecessary claim barriers or even complaints barriers for that matter. So that is obviously the 6 TCF principles. When we go out, we want to see it embedded, and to move away from the compliance, or rather tick box approach. We really want to see it, and therefore, if you'll see, the COFI standards will be a lot less, what's the word, prescriptive, but it will rather be you applying your frameworks to ensure that it does actually, ensure fair outcomes to policyholders, in our case, which is obviously the insurance market. Thank you. Next slide, please. Okay, so some of the tools that we use is supervisory meetings, desktop reviews, and supervisory inspections. So I'm just going to spend just a few seconds on this. The supervisory meetings is what we use in order. So say for instance, your entity is considered high risk based on our previous engagements, based on the tools, based on conduct of business returns. We will meet with you more frequently, and we will try and drive the correct behavior. And we also try and work with our sister regulator, especially when they have meetings as well. So that also try not to tire the industry out with so many meetings. We try to also collaborate where possible. And also some of our desktop reviews, the conduct of business returns, which is quite prevalent in our space, in the insurance space. We use that, from a data perspective to understand the insurer and how they behave, and to ensure that there's fair outcomes. We look at indicators, and from those indicators, we have then conversations with the insurer to ensure that there's fair outcomes to policyholders. And also the inspections, these are your more formal type reviews that take place. And this is generally informed by also our conduct of business returns or previous engagements, or it can also be if you're new to the market, we need to check to see, if you're able to comply with these standards and treating customers fairly in the end. Okay, next slide, please. Okay, so what is our focus areas for 2022, 24 and 2025? That's the Omni CBR rollout. So as I mentioned, we as the insurers had the privilege of having a conduct of business returns. But now this Omni CBR will be across the sector. So this will include your advisory, your FAI, your financial service providers, as well as your investment providers. The list goes on. And obviously it will be an update on the insurance return as well. COFI readiness. So there's always been a lot of interest with regards to the COFI readiness. From our perspective, how we're getting ready for COFI is obviously with Omni, in relation to Omni, making sure that our systems are aligned, making sure that our risk-based supervision takes place and it's aligned. And the other component is around sustainable finance, crypto assets, which is quite topical as well. In this, while I'm not close to this particular area with regards, but I do know that financial services, some of these financial services that provide crypto is also now being licensed as well. And I spoke to you about the supervisory framework implementation as well. When we look at specific focus areas for our department, at the moment we are developing tools because we've got all this data coming through from the insurance industry with the conduct of business returns. So we're developing tools so that we're able to reflect back to them from an industry perspective of what that looks like, especially if they want to know overall, how they claims, repudiations, withdrawn of claims looks like overall. So that would be your data that's overall. With regards to, we also support insurance that are in financial distress. We work with the PA quite closely, but we want to ensure that customers are also not prejudiced, by an insurer going under. So we use the term ICU. We place the insurer under ICU, but at the same time, we want to ensure that customers are not prejudiced through the solvency threats that could be posed by the insurer. And obviously, the undertaking of the emerging and overarching risk pilot project on thematic review on consumer credit insurance. This is the project that is currently underway. And then insurance protection gaps. So what are those insurance protection gaps? So especially with the recent grid failure, what has come to fore, and it's not only the grid failure, but climate change, um,
I think, Brenda, we can't hear you. Are you back on? Okay. So I think we have a little problem here. Um, I think Brenda probably has a connection issue. I see now she's fallen off. I think with regards to the FSCA, while we're waiting for Brenda again, it's a
I'm
very
sorry.
important. Are you back?
Yes, for some
Okay.
reason I seem to have lost connectivity. I don't know if it's do you think I should just disconnect from VPN? I'm almost done anyway.
Yes. Now, you know what? Let's continue.
Okay.
We can hear you loud and clear now. Right.
Okay. So I was still talking about the protection gaps, but basically we want to ensure fair outcomes to consumers. And now last is just to briefly touch on the consumer credit and credit life project that is currently underway. And this is how myself and the MFSA got introduced is through the consultation process. And what sort of led to this particular project is especially during COVID, we saw that the claims ratios were quite low. And even prior to that, it was quite low. So it's our hypothesis that sometimes the customer might not even know that they've got this product. We just want to ensure fair outcomes. But as we said, it's a hypothesis. We have not yet established what the real issue is, and therefore we are consulting quite widely. Previously, we wouldn't have consulted with the distribution channels because, this insurer would be subject to the review. But we found that it's quite necessary because of the type of product, because it's quite interlinked with a credit product, So, and this has been very helpful, especially with regards to our interaction with MFSA. So I just want to thank you again for your time. Appreciate it.
Right. Thank you so much, Brenda. I think from the association side, it was really good to engage with the FSCA, and the majority of our engagement specifically went with regards to the credit life, like you stated. And why some of our members are choosing not to offer that product, why it doesn't make sense, and actually why the consumer is deprived of this financial product. So, Brenda, I have one question for you, and that is one with regards to enforcement. So when
Yes.
our members hear enforcement and, enforcement from the FSCA as well, our members are already feeling it from the NCR, but what is the kind of enforcement that would take place from the FSCA side?
Okay, so as the supervisors, we do have powers with respect to, taking regulatory action with regards to sometimes directives. It would come in the form of a directive, but as I said, and we've got an enforcement department, especially where there's undesirable practices in the market, where there's fraud, scams, and things like that. And that takes place in there. We've got a dedicated enforcement area, departments and things like that. So there's different forms of enforcement or regulatory action. But when it comes to us, we really as a regulator try to first work with the industries, try to make sure that everybody that needs to comply gets into the market, to ensure fair outcomes to customers. We really use enforcement when it really is necessary, as I said, and where it's for us, our belief is it should be a deterrent. It's not the first thing that's in our minds. I don't know if it makes sense.
That is actually very comforting to know that, from a regulator's side, it's just not enforcement.
Yeah,
I think it's good, there's a working relationship with us in the NCR as well, where they're
yeah.
also trying to assist the industry. And if that's the FSCA's, first outcome is, let's see how we can get everyone compliant before we just start enforcing, that's really good news. So it makes sense.
I hope
Right.
so. Thanks.
Okay, the questions and answers, I'm not seeing anything from our side here. Brenda, if there is any questions, I will definitely escalate them to you. But thank you so much for doing the presentation, for engaging with the association and the industry, and also the FSCA, the NCR, and the MFSA engaging together to see how we can make this industry and financial inclusion a reality. So thank you so much, Brenda.
Thank you very much, everybody. Appreciate it.
Next, we have a video from Universal Insurance Administrators. Thank you so much. We really do appreciate your support. You've been service providers of the industry for quite a while. Then we've got a presentation by Anchor Point Risk, Eric Jenkins, Director of Information Management at Anchor Point Risk. Eric, we look forward to your presentation.
Excellent, Leonie, and thank you very much. It's a privilege to have the opportunity. I just want to say, fantastic webinar. I found the insights. It just reminds me how important our industry is, empowering people, empowering their lives, the difference we make, protecting them against fraud. So well done to all the presenters. And I just want confirmation if you can see my screen.
Yes, we can see that you are sharing it. Great. Thank you. We can see your screen.
Okay, just briefly, who we are at Anchor Point Risk. We're a specialist team. All have backgrounds from global consulting firms, focusing on data management and data governance. We assist a lot of organizations with data transformation programs, meeting regulatory compliance. In the data world, there's about 18 regulations, BSBS 239, POPIA, and helping, data skills development, putting their data operations in place, enhancing policies, help with the embedment of data SOPs in business. And then also integrating data governance into our risk and assurance functions. So today we're only going to focus on two topics. The one with, there's tremendous increase in cyber attacks and data leakage and compliance to POPI requirements. So we're only going to focus on two areas, POPI and DLP. I have with me Devana, who is our SME in the POPIA space, helping a lot of organizations with maturity assessments. We got a lot of information for your reference in the slides. We're just going to recap key points and what we've learned from an industry perspective, and then I'm going to hand over the next 4 minutes to Jared. Jared is our data loss prevention specialist, helping a lot of organizations with the monitoring, tracking, and reporting and prevention of data leakage. So if you can unmute Devona and Jared. Devona, over to you.
Thanks, Eric. Thanks, Leonie, as well. And a good day to the members and the various speakers. This morning has been quite an insightful morning with all the presentations and the information that was shared. So I'm going to be speaking about POPIA, protection of personal information, one of the top of mind topics in the boardroom. And the CEOs that have various challenges. It's basically your GDPR equivalent of the principles that have been adopted in the in Europe as well as the UK, and organizations are required to be compliant by the 1st of July. POPIA basically aims to regulate the protection of personal information, both in the public and in the organizations. A key understanding of POPIA key concepts: PI information is basically any information with contact details, medical and financial history. Data subjects are those individuals that the Act is trying to safeguard the information, and special PI is information such as religious benefits, trade, your membership, and biometric information. Next slide, Eric. So with regard to the principles, like any other legislation, there's 8 principles which organizations need to comply with: accountability, where you have your information officer that is responsible for compliance, your processing limitations, what are your limitations, what is the minimality principles, purpose specification, what are you specifically collecting the information for the processing limitation, is alignment of the information quality is understanding whether you have good data quality and current information. Openness is basically providing your data subjects with the concession that the reasons why you're collecting the information. Security safeguards is those measures to ensure basically that the PI information of data subjects is secure and individuals have rights. Your data subject participation. Here we're looking at the maturity assessments that we have helped organizations with across the industry, from the energy sector to the banking sector, as well as insurance, where we basically perform a maturity assessment on nine domains in POPIA. We set up workshops with key individuals and take them through various questions. We rate their compliance and provide them with recommendations. We provide them with observations, basically where their gaps are, where their weaknesses are, and recommendations on how to close these gaps. We have been very successful in providing this information and providing these maturity assessments to these organizations. It gives them a very clear understanding of what they need to work on. And where their weaknesses are. With regard to the various principles, the 8 principles, we've basically mapped key deliverables against each of the principles to ensure that if they comply with these key deliverables and they have developed and designed these deliverables, they are compliant with each of the principles. The next slide, Eric. The next slide, Eric. So with regard to the remainder of the principles, the same is for them, where if you have key deliverables against information quality, your openness, security safeguards, and your data subject rights, you are complying with these POPIA principles, and it gives you an understanding of where your weaknesses are, where your gaps are, and what you need to ensure continuous, your 3 lines of defense need to ensure that these deliverables are in place and embedded into business. If we go to the next slide, where we have our key takeaways.
Just checking, I am on that slide. Is it not
Oh,
updating?
okay.
Just
It's
present
not
again.
okay.
Okay. I'm
Yes,
just
it is
representing.
updating.
Here we go.
So what's quite important and what is quite a good checklist to go over is appointment of an information officer, and he or she needs to be registered with your information regulator, establish data sharing agreements both internally and externally, and ensure that that information is secure. Establish a popular incident management process and reporting process for breaches. Be responsible. So it's not only a certain team within the organization, everyone needs to be responsible. So all employees need to be responsible when collecting, processing, and storing that PI. Classification of your PI in accordance with the organization's classification standards. Ensure there's security safeguards, email encryption, etc. When emailing is done with PI information. Document key decisions made between the BUs to ensure that when audit comes, there is this documentation that they require. Destroy and delete information according with the organization's requirements for destruction of information. Implement a data quality management process so that the PI that you have is not outdated. It's always current, always complete, and always valid. And popular awareness, communication, and training. That is quite important. That needs to be done on a yearly basis.
Thank you very much, Devona. Guys, if there's any questions, post or please reach out to us. I'm happy to meet with you and discuss some of the popular challenges you might have. I'm going to hand over to the last half of our presentation to Jared Hendricks, who is our DLP specialist. Jared, take it away.
Afternoon, everyone. Thanks, Eric. So you can skip this, Eric. I don't think we need to run over what the agenda is. So just to give everyone a brief background of data leakage, data loss prevention, and data misuse, it's considered an emerging security threat to organizations. And I think the biggest reason is because it's carried out, and especially carried out by insiders. So the reason for that is it's in most cases, it's very difficult to detect and prevent insider threats. So that's, a lot of time we look at events that happen from outside the organization, what's trying to come in. We don't look at necessarily what's inside our business that's going out. And so a lot of the time it's vulnerabilities that they know of the internal systems or processes, etc. And what DLP is the practice of detecting and preventing data breaches, unauthorized data transfers, or unwanted destruction of confidential data. Organizations then use DLP technologies, processes, or techniques to secure and protect their data. And again, it complies with regulations such as POPIA, which was mentioned previously by Devona, GDPR, and then Section 14 of the Constitution. Eric, I think we can move on. So why do we need to consider DLP? So just a couple of high level is, remote work, too little or too harsh restrictions, theft of laptops, control weaknesses within the organization, how we share data. And what it leads to is it leads to data loss, and that, that can lead to fraud, theft of IP. And the biggest thing is the outcome. So reputational damage, productivity disruption, reduce competitive advantage with the rest of your competition, and then the legal and regulatory non-compliance, and then the big one is loss of customer loyalty. Next slide, Eric. So just a couple of benefits of a DLP program. This is high level. So a big thing and what most is you want to improve visibility and control. And that is, who's sending what information lies where. You want to be able to classify and monitor sensitive data. So you want to know where your data lies, how it's accessed, and the movement of that sensitive data. You want to look at detecting and blocking suspicious activity. So you want to be able to scan your environment, understand what's being copied onto USB drives, what's being accessed or unauthorized unauthorized access in a SharePoint environment, etc. Then we look at automation, and the big one, maintaining regulatory compliance, and then monitoring the data access and the usage. So you want to be able to monitor who has access to what in any time. What we do from a DLP perspective is we have a roadmap that we follow, so seven key steps, and just some high level of that is the first one is management buy-in, so obtaining the support from the executives. We then understand where that data lies. We provide ownership, so appoint data owners or custodians who's responsible for that data. We then look at a DLP strategy and a business case around that. We define the policies and the procedures of how, what data needs, how the controls, standard operating procedures. And then a big one is awareness and training, continuously passing on and providing knowledge to the users as well as the executives. And then one of the tools and the components that we use is a Microsoft Purview product. And what this is just a high level overview of that. So understand, know your data, protect your data, prevent data loss, and then manage the life cycle, your data life cycle. So a couple of key components is encrypting your data, controlling those encryption keys, identifying where your data risks, and managing your regulatory compliance. A lot of us, and a lot of the time, there's a lot of compliance, a lot of regulations, and the understanding, and in one central place that you can manage all of those regulatory compliance for your data just makes managing that and managing the staff and the data a lot easier on a day-to-day basis. Next slide, Eric. So just a couple of overview of what the compliance is. So it's visibility. So you gain visibility into your data assets across the entire organization, whether that's data in use, data at rest, or data in motion. It's access, so enabling access to your data security or disabling access to certain things. We're safeguarding that data. So how you manage those sensitive data, and it's across cloud, app, and endpoints. So that's, I think, one of the big benefits is that it's across multiple applications or devices. Your compliance, and then empowering the organization to govern, protect, and manage that data in a new comprehensive way. Next slide, Eric. So the next thing and the next steps to our DLP assessment is this: is we obviously want to understand what data in motion, data at rest, and data in use within the organization. We evaluate the existing policies, so that includes your governance policies, and it's IT, social media, bring your own devices, etc. We'll have a look at all of those. We then investigate and review all your system storage structures, whether that's structured and unstructured data, and we look at any tools that you have in place at the moment that can be utilized for DLP. We then review access to data sources. We monitor the movement, whether physical, electronic, or obviously digital, and then we provide a full risk assessment feedback on that assessment. And then just a couple of annexures that we've added in just for reading purposes, just a couple of things in terms of maturity concepts based on the modules within Purview, from DLP, lifecycle management, records management, etc. Thank you.
Jared, thank you very much. And to all the MFSA members, thank you very much for the opportunity. I hope you found it useful. If there's any questions, just post it. We'll answer some of them or reach out to us. We would love to help you with POPIA and DLP. Thank you very much.
Thank you so much, everyone, for your presentations. I really do appreciate it. I think, all of these compliance requirements are so important. That's definitely adding to the load you already have, but make sure that you use the right service providers when looking into this. We're going to end off with a video from Groups Are Us, and then we are going to take a 10-minute break.
When I was a young boy living in the city, all I did was run. Staring at the lights, they look so pretty. Mama said, son, you're gonna grow up, you're gonna get old. All that glitter don't turn to gold. But until then, just have your fun. Boy, run. Yeah, run. Run. When I was a young kid living in the city, all I did was pay. Every single dime that good Lord give me, I can make it last 3, 4, 5 days. Living it up, but living down low. Chasing that luck before I get old. Looking back, oh, we had some fun. Boy, run. They'll tell you that the sky might fall. They'll say that you might lose it all. So I run until I sun. And run, run, run. Yeah, one day will the sky might fall. Yeah, one day I could lose it all. So I run until I hit that wall. If I learn one lesson, count your blessings up to the rising sun. And run, run, run. Run, run, run. Didn't get everything that I wanted, but I got what I need, yeah, yeah. I see that light in the morning, shining down on me. So take me up high, take me down low, bear it all in, somebody knows. But until then, let's have some fun, yeah. Run, 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 run. They tell you that the sky might fall. They'll say that you might lose it all. So I run until I hit that wall. Yeah, I learned my lesson, count my blessings up to the rising sun. And run, run, run. Yeah, one day will the sky might fall. Yeah, one day I could lose it all. So I run until I hit that wall. If I learn one lesson, count your blessings up to the rising sun. And run, run, run. Run, run, run. Yeah, run, run, run. Yeah, I learned my lesson, count my blessings up to the rising sun. Yeah, I learned my lesson, count my blessings up to the rising sun. Yeah, if I learn one lesson, count your blessings up to the rising sun. Yeah, run, run, run.
Thank you so much, everyone. We are going to take a 10-minute break. We will be back at 25 minutes past 12. And then we are going to see FIC, National Credit Regulator, and we are going to have a financial inclusion discussion. Great. Thank you, everyone. Welcome back, everyone. It's 12:25, and I think that there's a lot of items that we are going to touch on the second part of the session. So first up, we have a presentation by Henry Leroux from CompuLoan Cloud, Experience Comprehensive Cloud-Based Loan Agreement Solution. Henry, welcome, and we look forward to your presentation. After that, we will look at Jan Augustijn, and then also we will have a presentation by Brett, as we stated, and also the National Credit Regulator. So Henry, welcome. Has Henry joined the session yet tonight?
Hi, Leonie. Sorry, I just didn't want to unmute myself for some reason, but yeah, here I am.
No problem. Great.
Okay, let me just jump straight in. Okay, you guys should be seeing my screen. Thank you for the introduction, Leonie. Let me get into it straight as we've got some time to catch up. So first of all, I want to show you guys our cloud-based solution for credit providers. Today, first of all, I would want to show you a run through of looking up a borrower and starting up an application in our system. You can search by using any identifiable data in the system. CompuLoan Cloud is hosted on Azure and provides you high availability. All you need is an internet connection and a browser. So here we can see I've looked up my borrower. That will bring me back to my profile with a complete financial standing of my borrower, as well as showing of the last credit scores. So if we want to start up a new application, it will bring us to the application section, and I can choose my branch. I've got the rights to pay out on multiple branches being in the cloud, and we'll bring up a credit report. At this moment, the system will pull in all credit or data from the credit report into the system for decisioning, and I can also open up this on a new page if I want to proper view my credit report. So affordability, especially in this platform, I want to go into affordability a bit, starting off with showing how we adhere to minimum affordability guidelines within the system. So yeah, I'll open up an application I started up, and we will go straight to the affordability section. So there's no data at this moment, and I would put in an income of 8,000 Rand. And we're going to put in a expense as well, just another for 500, just to show you guys how it will adhere to it in the system. So calculating does all the decisioning in the system based on the products that you've set up. And at this moment, we can see based on the minimum affordability guidelines, the expenses below the recommended threshold. You can override it if you've got the sufficient rights in the system. Obviously, we won't support that away, but if there's a reason as a manager, you can override that, and I'll also just show you how we will then report on the affordability in that regard. So we can see the full 7,500 being taken into account, and we can print that affordability. There we see the minimum regular amount was taken into account, and if we scroll down, we can also see that it was overridden, and the description and by who it was the override was done by. Okay, so that's just a little bit just to show off how we take care of to adhere on the guidelines. And then the affordability. So to just go into the full affordability of the application we started up earlier, we can easily go bring up that application again, and we're going to jump straight to the affordability section. So on this branch of mine, I've got a setting on that pulls in the previous successful application that was paid out, affordability, to speed up the process. So now the user can review the affordability, any items that's changed, but we pull in all the financial obligations from the credit report that we just did. So you can see there the adverse data is pulled in as well. And here we also got a user right in the setting. If you've got the right, you can override this. If the borrower can prove that some of these financial obligations has been paid up, or you can make contact with them, you can override. Sometimes we've got problems on the bureau perhaps, and you can override that. And then I would just want to, after you review your expenses obviously and your income, you can then calculate this application as well, or affordability I should say. The system will then check all your products and kick out the approved products or any declined products. We can also see the discretionary income there of 567. And let's have a look at this affordability. So once again, this affordability will be accessible throughout the life cycle of the agreement. The report dates there, all the data that was taken into account for transparency, and any overrides that was done. So on affordability, also we will show what was unticked and by who in the description. And you can also go ahead and sign this affordability. So we make use of Amplifin's terminal here. I did speed up the capturing of a signature a little bit to make the 10-minute mark. So there we can see our lender is signed. You can view that signature to just make sure it looks good on your affordability. And you can go back and get your consumer to sign as well. Throughout our system with our contracts, this is pretty much what our signing will look like. So we go next. Our affordability is back and we can see our signatures, and you can then finalize this affordability. What this means is that is now my affordability against this application. Whenever I will open up this affordability again, I will get my affordability with my signatures on it. Yeah, that is affordability that I wanted to show. Then recently we got e-wallets back into our cloud solution as well, and I thought I'll just give a little run through on that as well. So once again, let's open up that application. Did my video not freeze? Oh, there we go. Okay, so as soon as the application load, let's say we did our addresses, employment data, and banking, we go to wallets. On Create Wallets, we now ask Amplifin, is there existing wallets on this borrower, and bring back any information you do have. So at that moment, we can see a wallet came back, and there was a linked cell phone number that the number does not match my in-system contact details. So we can cancel that through the integration to make sure we then submit a number that we have got for this borrower. There we're setting the wallet cell phone number. And then through the integration that goes through. Okay, that's the cell phone number. And then we can also link a new FESA card. The FESA card that there might be expired or old one. So let's just cancel what we know is on Amplifin at the moment, and we can set a new wallet or FESA card, I should say, on the borrower. So we can just use our sequence number that you will get from Amplifin. And we can also set the expiry date to just prevent you from paying out any money to a FESA card that has expired. So at least give you the validation thereof. Okay, after that, we can print card issue receipt to. This is also pulled straight from Amplifin, and you can provide this to the borrower or for your own safekeeping. Okay, that's e-wallets. And then product selection. So if you need to select product, we'll get all those approved products. We'll also see which product was declined, any failed reasons you'll be able to see. For this demo, we're going to take the 6 months one. We're going to be paying out R1,000. On the right-hand side, I can see my default interest rate of 36% and my first annual of 60%. So if it was a first loan of the calendar year, we would have used that 60%. I can choose integration. We see in our integrated ASPIS as well. I'm just going to choose the optional one and make sure my fees is correct. Calculating installments. Here I see my installment breakdown that I can run through with the borrower, all the necessary information. And we go ahead and choose how we're going to repay this agreement and how we're going to pay it out. We're going to make use of Amplifin once again. Let's use their TTD1 real-time option. Select our bank account. We aren't going to sign it on payout. We're only going to print it. And then we're also going to select to pay straight to a wallet. So just now we can see all my wallet details we just set up is in order. Also sponsor the first withdrawal. And we can go to the next section. Supporting documents, very important. This is customizable by the client. Please add as many supporting documents as you want. The naming is customizable, just showing you how you can view any of them, make sure they are up to date. And any contractual document, we can do custom contracts or the default contracts. As I said earlier too, all the contracts can be signed here as well. So submitting the application and we'll pay out. So at this moment, we are contacting Amplifin once again, creating that debit check agreement and also creating that wallet payout. Okay, that should be our debit check created. It will also pull then through the mandate for display. There we've got the mandate straight from MFSA, and you can review, also get signed if you want. And then we should land back on the borrower profile. Okay, then lastly, now that the agreement has been paid up, where do I find all the documents that needs to be provided if you should come under investigation? So in our agreement section, you can easily go look up the agreement we just paid up. All the information, the breakdown is here. I can view my previous inquiry, my affordability. Let's just view that affordability again. See, this is the one we signed. So this is where you'll always find that affordability, as well as your previous inquiry. And like I said, all supporting documents, all contractual documents, including the ops mandate, can be printed from this centralized spot in the system. And that pretty much concludes my demo. If you would like to know more about CompuLoan and what it can do for your business, please get in touch with Experian or your account manager. And that's from my side. Thank you, Leonie, and all members.
Thank you very, very much for sharing the information. Like I said, if you've got any questions for Henry, please send him a message and he will definitely get back to you. So up next, we have a very familiar presenter, Advocate Jan Augustijn. He's also now the Manager in Supervision and Enforcement at FIC, at the FIC, and he's going to do a presentation for the MFSA and our members. Jan, we really want to welcome you to the platform once again, and we really want to thank you for your time, as we know you are very busy, and spending time with our members are very important. So, Jan, I'm going to hand over to you.
Thank you very much, Leonie. I hope you can hear me loud and clear.
Yes, we can hear you.
Excellent. Excellent. So this is a very important topic, and I know we're pressed for time, Leonie. And we had a session earlier in the year where we had a good session earlier this year where we also had great participation. And I'm mindful that some of this information will not be new to everybody, but I think there are a few things that we need to highlight. Especially since this is a FATF week, FATF standing for Financial Action Task Force, and they are in Cape Town busy looking at South Africa's grey listing and the fact that we have a lot of obligations that we need to report on every quarter. And we're reporting now back on how we are complying with the FATF requirements. So maybe next slide. My discussion will just be very quickly about dissolving and exiting the grey list. I just want to make some comments about the grey list. Leonie, are you guys moving the slides for me, or do I need to move them on my side? Okay. Yeah. So dissolving and exiting the grey list is the one issue that I will be quickly dealing with. And then just how this ties in with the risk and compliance returns that are required from accountable institutions. And of course, credit providers being an accountable institution since December 2022 has these obligations as well as the compliance obligations. And then I just want to touch on inspections and enforcement that we are doing at the FIC, which also will impact on credit providers as we move along. So next slide deals with just an extract from the action items in the grey listing environment, FATF environment. And I specifically want to alert the audience to 2A, which says that South Africa should improve risk-based supervision of DNFPBs. Now, I'm mindful that everybody does not know these acronyms. DNFPBs are designated non-financial bodies and persons, and in order to supervise the industry, it is important that we use a tool that indicate to the regulator and to the supervisory bodies, the Reserve Bank and the FSCA, where the higher risk institutions sit and who they are. So high risk, medium risk, and low risk. And it's important from our point of view that when we conduct 2B inspections, that we also look at doing those inspections on a risk-based approach. Quite important, and I'm going to skip training and awareness. We've been doing such a lot of training and awareness, and specifically in the credit environment and its the FICA obligations in the credit environment. But 4 is quite important for me as well, because 4 indicates from a financial action task force perspective that South Africa should demonstrate that all AML CFT supervisors apply and monitor implementation of follow-up remedial actions. So one remedial actions are followed up on, and that effective, proportionate, and dissuasive sanctions are being applied. And that is quite important. It means that the sanctions that we issue must be effective, proportionate, and dissuasive, meaning that when we sanction an entity, it must also dissuade other entities from non-compliance. So we need to continuously report back on these issues, and you can see, therefore, why it is so important that accountable institutions comply with the FIC Act, and particularly the new institutions like credit providers come into the fold easily and comply with the FIC Act requirements. So the next slide, if we can quickly go to that. So the question now is, who are the credit providers? So credit providers have been provided for in Schedule 1 in the FIC Act under item 11. And it used to read a person who carries on the business of lending money against the security of securities. And there is not many institutions in this audience that would have fit that description. But that item was amended on the 19th of December 2022, and the category now includes all types of financial institutions, which is more in line with the FATF standards. And the FIC is the only supervisory body for these entities, except, of course, banks. Banks, as far as FICA is concerned, as far as anti-money laundering and terrorist financing is concerned, is regulated by the Prudential Authority at the Reserve Bank. Then, just to have a quick look at how this item 11 now reads, and this is quite important. It says that it is a person, a credit provider is a person who carries on the business of a credit provider as defined in the National Credit Act. So if you are registered with the National Credit Act, you immediately fall within the ambit of the FIC Act. There's just one exception to that rule, and that is when we look at an entity to register with us as a credit provider under the FIC Act, it needs to be a person who carries on the business. So as you know, in the National Credit Act, you will have situations where there's certain persons will have to register as a credit provider, even though they are not really in the business of providing credit. And then B is really dealing with credit that falls outside the National Credit Act and is more in line with the business-to-business lending environment. So quite broadly speaking, if you're a credit provider, you have FIC Act obligations. And it's so important for me just to make this point. These obligations are quite onerous. And if you are part of a money laundering scheme, even unwittingly, there is always a concern that when there's a criminal prosecution for money laundering, and the money laundering provisions in the POCA legislation, in the criminal legislation, being so wide that you may find yourself at the wrong end of a prosecution. And I always make this point to my audiences. When you register and comply with the FIC Act, you have the protection of the FIC Act when it comes to such criminal prosecutions. And sometimes the audiences don't make the link with the compliance obligation and the fact that if you fully comply and you report certain transactions, that there's certain protection that you have. The next slide, Leonie, is just a slide that explains a little bit on how we see enforcement and inspections. But this is actually a good topical graph in the sense that it's important to understand that the basis for supervision is not inspection and enforcement. It is actually registration, public awareness, public queries, all of those aspects. The PCCs, the public compliance communications, the guidance notes that we send out, the compliance monitoring, and then we sit with on top of this mountain with the smaller part of inspections and enforcement. So when we talk about supervision of the FIC Act, we do look at all of these different categories. And the aim is not simply just to inspect and issue sanctions. That is not necessarily the aim. The aim is very much to get entities to be compliant. But of course, there's a time and place for everything. And what concerns the FIC at the moment, and dare I say it at this time, at this point in time, is that we have extremely low numbers of registration of credit providers with the FIC. And this is going to be a problem. And we can't let this be. And we are conducting inspections and we are issuing administrative sanctions. So it's imperative for this audience to know that if you are a credit provider registered with the NCR and you are not registered with the FIC, that you can expect a call from us. If we can look at the next slide, Leonie. So let's quickly talk about registration. So in terms of Section 43B, read with item 11 in Schedule 1, there is an obligation on credit providers to register as an accountable institution with the FIC and then to fully comply with the compliance obligations in the FIC Act. That obligation stands. But a word of warning, we have in Section 50 sub 2 sub B Roman 2 of the National Credit Act, that is a condition of every registration in terms of this act, that's now under the National Credit Act, that the registrant must comply with every applicable provision of the FIC Act. So that's very important to know. And then also you must realize that Section 57 of the NCA says that registration with NCR may be cancelled if registrant repeatedly fails to comply with any condition of registration. And every condition of registration says that you must comply with FICA. I just want to make this link because what it does mean is that there's good cooperation and interaction between ourselves and the National Credit Regulator. And I've said it on many occasions, but people don't seem to make this link and that we are serious about this. It's an easy exercise for us to determine who is a registered credit provider and to issue direct sanctions without an inspection. And I think that point needs to be strongly made. It's just a question of issuing a financial sanction to that entity and to inform the NCR that we are issuing those sanctions. And we are getting to a point where we know that there's about 7,500 registered entities with the NCR, but we have in total, including the banks, only 1,500, close to 1,500 registered entities. And it's important for the industry to know this, because media is already talking about credit providers being the reason that we will not get off the grey list in South Africa. Now, that's not entirely true. There's far more to it than that, but the point is not lost. And this is out there in the media. So you have to accept that on this issue, we're going to take strong action. And then please don't say, but yes, you should have given us time, or you must now give us time to fix. Even if you fix at the point of inspection, if you're not compliant, then we can issue you with a financial sanction. And I think that's important to take note of. If I can quickly go to a step of registration and go to the next slide, which deals with Directive 7. And I must admit here a bit of a compliment to the entities who are indeed registered with the FIC. The figures in respect of compliance with Directive 7 is actually pretty good. So it means that the ones that are registered have, to a large extent, have actually provided the RCR compliance returns. Now, if I could just take you, think back on the first slide. In the first slide, we said that we need to develop a tool in order to establish what the risk is that the particular entity holds, whether that entity, that credit provider, is high risk, medium risk, or low risk. And we cannot fulfill that function if we don't have this RCR information. So it's critical that that when you register with the FIC, that you also provide us with your RCR information. It's quite easy. There's a link on, and maybe you can just go on to the next slide, Leonie. There's a link that also that on the website, and you just go in there and you complete that information. So just to have some understanding of Directive 7, it was issued on the 31st of March 2023, and the submissions was due by the 31st of July 2023. But we have kept this portal still open, so you can still submit this information. So even if you register now, it would be great if you can provide us with that information ultimately when you can, so that we can take that into account when we determine the risk of the various institutions. And please, when you submit your information, please ensure that you do this correctly, because first of all, you must submit in the document your org ID. Now that is an identity number that you will get from the FIC once you register. That means that you can't submit the RCR if you are not registered with the FIC. So the first port of call is that you must be registered with the FIC, and hence the emphasis on the registration part. In the next slide, you can just see to it. We have training videos on the website, and it's quite easy to follow. It's a simplified video that provides information on how you actually submit the RCRs. And with that, I'm going to walk off that topic for a moment and move to the next slide. And just deal with some of the compliance obligations. Now, I don't want to make this a training session because we just don't have the time for it, but there are some compliance obligations that I just want to allude to. Most importantly is, and probably all credit providers in this audience knows, that you must have a risk management and compliance program, an RMCP. But you can't have an RMCP if you've not done a business risk assessment. And there's such a lot of material on the FIC website on how you can do, particularly guidance note 7, which is quite important to take note of, because it assists greatly in having an understanding on how to do a business risk assessment and do a risk matrix of your clients, so that you know where your high risk lies. And that is so important, because once you know where your risk lies, you can give your attention to those areas in particular. And it makes the whole management of complying with FICA so much easier. So a risk assessment requires that you must have an understanding of how you as a credit provider can be abused for money laundering, terrorist financing, and proliferation financing. And how do you manage that risk through controls and compliance? The RMC must by now have been drafted, implemented, and staff must have been trained on both the FIC Act and on the institution's RMCP. So there's a lot of talk about this grace period that's provided. It's not really a grace period. And it simply said that we do not foresee issuing financial penalties in the first 18 months. That 18 months is now over. At the end of May, it's over. And we certainly will be issuing financial penalties. Simply because the levels of compliance is not what it must be. Then the other issue with the RMCP is, of course, that you must be able to tailor your customer due diligence according to the risk profiles of your clients. So all that means is that you will apply stringent due diligence where your clients are higher risk. And of course, where you sit with lower risk clients, the due diligence may be more simplified. But I know this industry well, and I do understand that as credit providers, we always want to know where we're going to get hold of that client when he enters into that loan. So what happens out in practice is that a lot of institutions, a lot of credit providers copy and paste an industry guide. That's not an RMCP. Don't be fooled. Those documents are all over the place in industry. You need to go through a process where you make this information your own, where you understand the risks that you may face in your environment. And the risks may be different. The risk in Nelspruit may be different to that in Johannesburg. And Nelspruit may be a higher risk in certain area considerations when it comes to client profiles than in Johannesburg. It doesn't follow necessarily that the one would be the same than another. So there's an inherent risk that if you use an industry guide as an RMCP, that when we come and inspect you, that you will not be applying the RMCP on your day-to-day business. And that may be an issue. Leonie, can we go to the next slide, please? So the next slide is, and as I said, I don't want to make too much of a training exercise on this, but the business risk RMCP is on top of that list. Then also targeted financial sanctions and reporting. FATF said when they conducted the mutual evaluation in South Africa, that South Africa does not have a full understanding of its risks for being abused by terrorists. And we don't. We don't. If you talk to a neighbor, if you talk to anybody, a fellow businessman, they will say, but this is not in South Africa. but there are so many instances, and it's reported widely, where South Africa is used to finance terrorism that takes maybe place elsewhere in the world. And we don't see that link. There was, I always allude to that story of the white widow that was in Centurion, who had a pie shop and who had links with terrorists. She was later sought in Kenya for that terrorist activities that taken place there, the bombings. So this is a crucial area that you need to comply with. Record keeping, as always, and I kind of think that credit providers is actually pretty good in this in this regard. You need to do account and transaction monitoring. By the way, we are not advocating that you must not do business with certain people. There may be instances where we will clearly say to you, no, you cannot do that. And you must freeze that account. But that's not the main aim of it. The main aim of it, of FICA, is to obtain ultimately good information from you as accountable institutions, so that the enforcement agencies can properly investigate and prosecute criminal crime, including money laundering. Then ongoing and enhanced due diligence is another key compliance aspect. And of course, governance and ownership of who takes responsibility with the compliance with FICA. So governance sits right at the top. If you are a CEO, if you are on the board of directors, if you're the chairman, if you are senior management, it sits with you. And the problem is that in terms of the FIC legislation, it's not only the entity that can be issued with a financial penalty or administrative sanction, it can also be an individual. So we can take to task, if there is no proper governance at the top of an institution, we can make that person also responsible and issue a fine. And then, of course, registration, as I said, and all credit providers had to be registered by the 20th of March 2023. And if you're not registered, you are not compliant, and you can probably not be only charged in respect of registration, but the mere fact that you are not compliant fully with the FIG Act. Please be aware of that. Next slide. Just a little bit quickly on inspections. In 2023, we've done 558 inspections. Key findings, there's no RMCPs, there's no business risk assessments, no document whatsoever in a lot of instances. Or there's an RMCP, but it's not based on a business risk assessment, so it's not tailored according to the risk that institution faces. And then the adoption of industry guides, which I've already alluded to, which is problematic. CDD is not conducted in a manner that's set out in the RMCP. So in the RMCP, we can see how you say you will do customer due diligence. But when we look at the controls and what actually happens in the accountable institution, then we can see, but no, that's not it. The CDD that actually is applied is not in line with RMCP. There's a reluctance to report suspicious and unusual transactions, sadly so, because everything that we do in respect of compliance is actually aimed at ultimately providing good reports on high-risk clients that can be used by the enforcement agencies. And by the way, there's a lot of protection for you in order to provide those reports. And then non-compliance with targeted financial sanctions. So the next slide just speaks a little bit to administrative sanctions and penalties. So as I said, we are not persecutors, we are prosecutors. Our aim is to a large extent to ensure that we get remedial action and that we get compliance from institutions. And when we get that compliance and there's full remedial action by the accountable institution, then of course we take that into consideration when we issue ultimately a financial penalty. So the sooner you comply, even when we conduct the inspection, the better. But do not think that compliance after a long period of non-compliance is going to absolve you from administrative sanction. We will certainly consider it, but that doesn't necessarily follow. It would depend on the level of non-compliance. So effective sanctions should change behavior, of course, be a deterrence for non-compliance by others, eliminate financial gain or benefit from non-compliance, and punish non-compliance. And in the recent case of Volvo last year, the High Court said specifically that the FIC Act punishes non-compliance. And that's an important statement to make. So just on sanctions that can be issued, yes, we can issue a caution and a reprimand and a directive to take remedial action. But the teeth really sits in the fact that we can restrict or suspend certain business activities. We can stop you from doing business for a period in time. And we can issue a financial penalty. And for legal persons, it is a maximum of 50 million. And for natural persons, 10 million. So you can see that the potential fines are quite steep. Last slide on my side. It's always a trade of mine. Just by my mere occupation, I tend to end on negative notes, and I do apologize for that. We are totally, the FIC is totally aligned to changing compliance behavior. But for last year, we actually issued 11 administrative sanctions, 2 in January and 9 in the beginning of this year. It still falls in the 23-24 financial year. And we issued fines from low to up to over 7 million rand for one institution. We have also issued 302 notices of intention to sanction for RCR non-compliance, and it's our intention to adopt this process that we have here also on non-registration with the FIC. So we will build on these figures in future. So, a warning from our side. Inspections of credit providers is now on the radar, with sanctions to be issued for particularly non-registration, RCR non-compliance, business risk assessments, no RMCPs, and general FICA non-compliance. And we've begged, and we have had webinars, we've had engagement with the MFSA on these issues. And we are unfortunately forced to a large extent also by the fact that we are on the grey list to issue administrative sanctions also now to the new sectors who've had ample opportunity to get compliant. Thank you, Leonie.
Thank you, Jan. Not the brightest ending note, but I completely understand where you guys are coming from. I think from an association's point of view, what is concerning for me is that there's definitely a correlation between your NCR registration and now your FIC registration. So if you are not FIC registered, but NCR registered, they can cancel your registration. And that basically can also lead to the restriction or suspension of your operations, if I understand it correctly.
Yes, indeed, Leonie. Yes, indeed. So and what I tried to convey even last year when we had engagements early on in the year already is to tell particularly in the micro lenders, because I've got a soft spot for this industry. I stood with one leg in regulation, and then I ventured on the other side, and I'm back in regulation. But I do love the credit industry, and I like the engagement with credit providers. But it is so easy for us. It's looking at the registered entities that we have at the NCR, comparing it with our list, and not even an inspection is required. We issue a notice of intention to sanction, and we immediately issue sanctions. And by the way, if we do not then get the remedial action and the compliance that follows, then there's a serious risk for credit providers that not only is the action taken from our side, but that the credit provider may say that you're not fit and proper to be in this industry. So that is a real concern for me, particularly because I'm fond of this industry. I don't want to see that happen.
Yeah, no, I agree, Jan. So if you would say from say there's members in the presentation now, what would you say if they don't know how to comply, what to do? Would step one to be first to register? Would that be, let's start there and get everyone registered? Because I heard you saying only 1,500 credit providers are registered from the, say, 7,000.
Yep, indeed. So quite correctly, you know, the registration under FICA is not the same as the licensing required under the National Credit Regulator. So it's not a license; it is an administrative function. So you don't have an obligation when you become registered. You already have an obligation in terms of the Act to comply. So it does not require you to register. But the issue with the registration is that you cannot report properly if you're not registered. You can't submit the RCR if you're not registered. And we have the perception or the point of view that if you're not registered, you're trying to avoid the scrutiny of the regulator. So indeed, the first point is to become registered ASAP. Now, we have a bit of a, you know, we've been in regulation, Leonie, you and I, for the last 20 years, more. Yeah, more. Let's not give away our ages. So we know how street's approach to when it comes to these issues. There's a tendency for industry to say they will not get to me, you know, and we've seen it now recently with a lot of the attorneys. They've been in business for whatever, never registered or never completed an RMCP, and now they are and now they are concerned. When we take enforcement action, and it's too late, you know, and then new entities come. But there's a lot of
Sorry, Jan, I lost the last bit. Sorry. I think everyone lost the last bit. Sorry, Jan. Sunay, from your side, can you hear anything?
No, Leonie, I see Jan has dropped off.
Okay, yeah, Jan seems to be cutting off and he dropped off as well. I think from the association side, it is very important that our members register with the FIC. We are going to draft an email for you guys to say, you know, what is your requirements and what can we do for you? We have an FIC booklet where we have, you know, templates that you can use, or, you know, just examples of what it looks like. And we really want to motivate our members to register, because if they actually go to the NCR and say they start doing a comparison and they start saying, you know, you can't be NCR registered, this influences everything. It influences your relationship with your service providers, with the consumers, you know, the legalities of everything into providing credit. So I see that there's a lot of questions going on, you know, what can I do? How can I do it? So now I also think we should send all of our members, the service providers that can assist our members with the FIC. I'm very concerned with regards to, you know, the compliance and the enforcement. We have seen enforcement and compliance inspections on our members. So this is definitely something that is not far-fetched. It's not something that's going away. We've seen these compliance inspections taking place. We've sent it out to our members to see what the FIC is actually asking our members. So I want to motivate everyone, please register with the FIC and then ask the association what service providers you can make use of in order to get you compliant. So now is Jan back on?
I am Leonie, and if
Right.
but if I can just say a comment on your on your last comment, we are so available to assist. By the way, so we've done webinars before. If you say to us, let's arrange a compliance webinar, then we can assist with that. We can make somebody available, have a 2-hour session, and run through the major compliance obligations and give a proper training session to the MFSA members. We can certainly
Thank you so much, Jan. That is definitely something that we are going to do. We've done a couple of sessions together with the FIC, but we are definitely going to do another one. Jan, with your position in the FIC and, you know, the soft spot that you have for the industry, we really do appreciate, you know, you coming to talking to our members and actually assisting us. There's really big appreciation from the industry side. So thank you for the presentation and thank you so much for the engagement.
Only a pleasure. Only a pleasure, Leonie. And I really hope that the micro lenders take it in the spirit that we try to convey this. Thank you very much.
Definitely. Definitely. Great. Okay. Let's go to the next part of the session, and that is a video of SureCard. Thank you so much. Next, we have a presentation by Akiba Digital. We look forward to the information that they're going to share, and that will then be followed by the National Credit Regulator.
Perfect. Good afternoon, everyone. I hope everyone can hear me. Can you please pull the slides, or should we do it from our side?
Thank you. I think you can share it from your side if you can. Right, we can see your screen.
Is it
Thank
just me or
you.
like there's a background noise that I hear on the call? I'm just not sure if it's only me.
No, from our side, it's quiet. Thank you.
Okay, perfect. Good afternoon, everyone. Thank you so much for the virtual webinar that has been put together by MFSA South Africa. My name is Obakeng, and we are from Akiba Digital. We will share a bit more about what we do towards the end of the session, but we thought that it might be helpful to just do like a quick overview of some of the interesting ways that we are seeing people leverage to just kind of recover the debt that they obviously kind of put out there. So that's what the presentation is just really going to be about. It's thinking about all the different data points that you can leverage as micro lenders and a bunch of different stakeholders within the microfinance sector to just basically better better recover the debt that you help so many South Africans with across the board. So it is very well documented that South Africa has a big spending culture with really low savings levels across different parts of the population. And this is no surprise because across the world, there's very low growth rate, and we just face a really, really tough just like economic climate. And customers have had to turn to more accessible revolving as well as unsecured credit facilities to be able to supplement their kind of income. However, the challenge with this though is that when we look at our debt to income ratio, it currently sits at about 78%. And this added financial pressure is not made any better by the fact that we are just coming out of a festive season, typically in the first quarter thing of the new year. That really makes collecting debt just like even more difficult. What we know is that South African customers currently have a credit extension that sits at around 1.8 trillion, which is about 9%, with about 9% of this 1.8 trillion that currently sits in areas of at least 3 months. In addition, we have about 45% of the 22.5 million credit active customers that have impaired credit records. This obviously further makes the challenge of collecting the money really, really difficult. And one of the things that we are kind of seeing is because there's such a huge concentration of the amount of people with impaired credit records, and typically what this means is that a lot of collectors across a bunch of different industries are like trying to like solicit payments from the same consumers. It is no challenge to obviously get money from the same people who owe relatively high volumes of that 1.8 number that we kind of put thing up front. Here's what we think typically happens in South Africa. There's a very strong increase when we look at the year-end spending of a lot of South Africans, and we typically see that in the first month of the year, where a lot of people overspent in the festive season, and this often results in many lenders seeing a notable increase in the amount of accounts that are in areas within their portfolio within the first part of the year. So we therefore thought it's really, really important, given that we have a lot of micro lenders and a bunch of different people who are different stakeholders within the lending ecosystem, that we really think about some of the effective ways that you can really optimize how you think about debt recovery, particularly given that there is a typical seasonal increase when we look at just like what the numbers tell us. However, we also do know that the cost of trying to just recover debt is quite high. So therefore, we think that it's very, very important that credit providers leverage data that they have both internally within their teams as well as from a bunch of different data sets that like exist across different parts of the world, the people they have in their team, and just so many technological resources that are available at their like disposal to really come up with what we call an insight-driven collection strategy to really maximize recovery rate, but while also managing just the cost of just like recovery. here's what we think kind of needs to happen. So we like call this a balancing of skills. When you think about what like collecting the debts that are owed to you kind of looks like. So the first one that we think is really, really important is that while when we look at the kind of like typical way that collections are done, which is the debit order kind of method, is really, really important. We also do know that there will always be some level of defaults on the different accounts that the different credit providers make available to both businesses as well as to just individuals. That we think is really, really important that how lenders think about collections must really prioritize just the different types of actions, and the cues that they take into account must really think about managing all the overdue customers within their individual context and within their individual merits. Credit providers often than not will want to be the first in line to collect against customers who have multiple debt obligations through a bunch of different service providers. Collectors should obtain a very comprehensive insight on the consumers by analyzing the data which they have at their disposal and think about what is the best way to use some of this data to collect effectively. And we will share some of the data points that we think really does put many credit providers in a good position to be able to recover the debt that typically goes just like unrecovered or like has to be sold to a different provider. So when we think about what the best practices are, we like definitely think that collectors should find an optimal balance between driving effectiveness as well as efficiency. For example, it is a lot costlier for you as a credit provider to go against easy targets. And by easy targets, we mean customers that are both willing and able to repay their debt, as often many of these customers will self-cure, meaning that they will often not pay without a collector taking any action. Rather, what like we definitely think should kind of be done is to focus a lot of the energy on, to focus less energy actually on the slightly difficult targets. And I will go into an explanation of what I mean by a difficult target. So an example of a difficult target might be a customer who has entered, who A, is unable to pay because they've entered kind of like some level of a debt review, that we think possibly like in like terms of a strategy, it's knowing that data point that they've entered a debt review, then one of the things that you might do is that you might set those accounts aside and monitor them up until they kind of exit debt review. Meaning that the money that you'd have spent in that time to kind of collect the money, to like basically collect the debt, you can use it for slightly easier targets where there is an intention to pay as well as the ability to pay, versus sometimes spending the same equal amount of effort across a bunch of different target thing across a bunch of different targets, regardless of whether they have both the ability as well as the willingness to pay. The other thing that we think is really, really important is that typically what we find is that optimal collection strategies consider the fact that some customers don't have the funds to really meet their full monthly debt what do you call it, debt obligations, but there are some that may be able to pay some portion of their debt. So when you think about all of the different data points that you have a thing that you have available at your disposal, some of the things that you might choose to do is leverage data analytics to kind of predict the possible date, the like best possible date to be able to collect against a customer based on what their historical payment behavior looks like. Having this information readily available, and meaning that you align your collection strategy to date, means that you as a collector have a higher likelihood of being able to successfully collect on the debt that is owed to you. And when like thinking about the best possible collection strategy, we like definitely think that it's important that a collector weigh out a customer's likely reaction against the customer's potential monetary value, as well as just like future value of what they may be able to do. So, and then, so kind of like an example of this is when you as a collector definitely alienate a first-time defaulter who's only a few days behind in making a payment by using a very aggressive collection method, you may cause this customer to take their business elsewhere, which is not really what we want. So the key thing that we're really advocating for here is that if you as a collector have access to multiple different data points, how you think about collection can A, be able to like save you money, B, really increase your just recovery rates, and then C, basically ensure that you don't have as many accounts that are like in areas as we currently are seeing in the market. Then on the other part, one of the things that we think should really be kept in mind is that what may have typically happened in the past from like a debt collection perspective may not necessarily be what is kind of useful today. So in that regard, it's also very important that we keep track of all of the different ways that data can be used, and like data is like currently being used, where some people do like what you call a test and learn, where they would take a significantly smaller part of their books and they really try to think about how to optimize a bunch of different collection strategies. In like other words, what like this might look like is to obviously select that like small portion of your book and test out a bunch of different ways that you can leverage data to either collect, B, make contact with that relevant person. And the key things that like kind of really underpin the ways that we like suggest for credit providers to get as many data points as like possible to be able to really tailor how they think about collection to every specific customer segment is that what we hope this will do is definitely yield quite a strong return on investment for you by allowing you to drive, as I've said, very high recovery rates, reduce the cost of collection, and hopefully increase the profits within your business. Here are some of the key considerations that we think from a data perspective can be helpful when you think about what you need to be able to increase your like basic chances of like collecting the debt. It's the age of the debt to kind of to basically recoverability. And what we mean by that is that there's quite a strong correlation between the age of debt and your ability to kind of recover it. Simply put, the older the debt, the more the chances decrease that you can be able to basically recover that debt. Second to that, if you're a provider that operates in more than one geography, I think it's important to take into account what the regulation and the compliance of collecting debt in that specific geography looks like. Thirdly, which is a really, really important part, which is the documentation part of it, right? Is that documentation is probably one of the most important element in like determining whether you're going to be able to collect on an account or not. Having as many data points as possible about your potential potential customers as well as your as well as your current customers is really, really important, and that's where we like as Akiba can like kind of even come in and then just like help out because of the multiple data sets that we have that you that like basically help you get the most clearest picture of what your customer what your customer's transaction history and just a bunch of different important data points around who they are and their kind of behavior. And then thirdly, it's just the historical data of just the accounts that that particular customer might have. Is that typically when you work with a delinquent customer, when you look back as to what their historical track record are, there's a bunch of different interesting data points that you can pick up that will help you kind of mitigate the risk of taking them on within your books. And then thirdly, just the account type. So the account type also makes a big difference. So an example is you might be taking on a customer that has no previous historical credit history. You might be taking on a customer who's kind of prepaid, who's maybe fallen through the cracks once or twice. Or you might also be taking on a customer who has like ignored it and who has ignored an invoice or two without really stating just like the reason of like why they may have done that particular thing. So what we hope that this short brief time kind of gave you just like an insight into is that data is really, really important when you think about how to best run your business to recover more of the debt that you currently have in areas, to increase the profitability that you have, and then thirdly, to just reduce the cost of what it takes to just basically collect that debt So we at Akiba basically provide a unified unified origination experience. And how we're able to do this is we have a single API integration, which you can think about it as a plugin that allows you to have access to hundreds of basic data sets that allow you to better know your customer, better know how to kind of verify your customer, be able to pick up any risk from a default as well as a collection perspective, and then thirdly, to be able to kind of monitor any fraud that you might incur with dealing with said customers. We hope that this was useful, and we are definitely more than open and willing to have a conversation with like anyone that might be interested to think about how different data sets that you might have access to might help you run your business practice a lot better than you currently do. And I will drop my my details in the chat, and we look forward to having a conversation with you. Thank you so much.
Thank you so much. We do appreciate it. Yes, put your details in the chat box and we'll take it from there if members are interested. So let's listen to the video of Altron, and then after that we are going to listen to the presentation of Brett.
At NewPay and Delta, we are passionate about our customers and about their businesses. It has long been our philosophy that your success is our success. As time moves along, so the Altron FinTech solutions evolve and continue to develop. In our partnership with our customers, we uncover niche innovations that ensure that your systems perform better every day in DebiCheck, making you more successful in the management and collections of your credit. Our account managers continuously analyze statistics and conduct training on the DebiCheck platform to help improve your business success. Our Delta solutions offer you a configurable solution that caters for your unique business requirements. Amongst others, our solutions offer options in security, biometric access, paperless contracting, as well as automated and integrated insurance solutions that generate a continuous revenue stream for your business. Altron FinTech offers app-based DebiCheck processing, negating the requirement of a terminal for people on the move. An agent module can be used to originate credit, which is integrated to our WebFin system, as well as credit bureaus, payment systems, new card, and of course, our new cover insurance solutions. All these services can be accessed remotely through an application on your mobile device. Altron FinTech supplies one-stop solutions covering all aspects of credit in a turnkey solution for your business. With dedicated consultants and skilled employees from multiple support desk teams, as well as technical support staff ready to assist and support you. NewPay makes use of multiple acquiring banks and can accommodate your business through various channels, including NewPay Direct Channel, where we connect directly with the banking network to BankServe. We are here to take care of your processing and collections while assisting you to grow your business systems processes. As Altron companies, NewPay and Delta strive for a more sustainable industry for all. Ethical business practices are part of our group's core set of values, and we continuously take measures to drive this value within our industry, enabling you to optimize your collections. We have partnered with Dr. Roelof Botha and Gibbs economist Keith Lockwood to publish 2 quarterly reports that can assist you in making better business decisions. These are the Altron FinTech Short-Term Credit Impact, or AFSCI Index, and the Altron FinTech Household Financial Resilience Index, or AFHRI, which are released on a quarterly basis. Links to these reports can be found on all our social media pages for your review. The various teams of people from NewPay and Delta are focused on customer service and delivering innovative solutions to assist you in growing your business. Our aim is to offer you solutions for small and large businesses that are tailor-made to suit your requirements and your pocket. These solutions include 1. Strike data analysis to optimize collections. 2. Remote enablement and loan applications through Quick Kadima to grow your business. 3. Guidance in compliance through our solutions that assist you to operate within the legal framework. 4. Voice over IP contracting and mandate recording for remote operations. 5. Signing documents from remote locations using a smart device or paperless in office to reduce your carbon footprint. 6. The ability to process and acquire through 4 different banks with backup and failover between them in case of systems challenges. These solutions are just a few of the many ways in which Eltron FinTech provides innovative and simplified FinTech solutions within the credit and payments landscape. Eltron FinTech. We are passionate about your business and drive various solutions as combination packages or as single solutions to assist you in achieving success in your business.
Right, thank you very much. Up next, we have our next speaker. It's Brett van Aswegen. Brett is also now a board member of the MFSA, and he is also a credit provider in the industry. Brett has got extensive knowledge about the industry, about data, about the National Credit Act, and he's going to present on South Africa's financial exclusion crisis. And this has got a lot to do with our members and what's happening in our industry and our environment. Brett, we would like to welcome you to the platform, and we really look forward to your presentation. I think you are on mute.
Thanks, Leonie. I appreciate that very much. Hello, everyone. I'm sorry I'm not there in person to see you face to face. I think that these remote sessions are always more difficult if you can't engage with people, but I will do my best to make it engaging and entertaining. What I will say to you is I've got nothing to sell to you, so you don't have to worry about a sales pitch. And I also only have 4 slides, so it will hopefully be short and to the point. I'm going to just share my screen with you quickly so that I can present. Share screen. I'm not allowed to share the screen. Leonie, could I ask you to share?
So now if you can share the screen.
You can share. Right. Distance. Can we just, oh, you got it there. All right. Thanks. You can just move on to the next slide. Can I control the slides here? Yes, I can. Hey. Oh, no, that's, yeah, control. Oh, there we go. I can, yes, I can. Thank you. Sorry about that. Okay, so just starting off here, let me just maybe start before I get stuck into the data. I would like to say that we've kind of stumbled across a bit of a problem in the industry. And it started last year, early last year, when at Wonga, we had to make the very tough decision to stop lending to thin file clients. And it kind of rocked me a little bit because it's been a part of our business model that makes a lot of sense. We have the kind of product, the term of the product, to be able to provide an entry level for people trying to enter into the formal financial markets and use formal credit providers in the market. And when we made that decision, it was based on the economics of the segment of the population that we were trying to service, and we just couldn't make it work. And so it was a commercial decision to stop lending to first-time credit users, but one that didn't make sense with what we were trying to do as a business, and providing financial access and inclusion to people who, you know, otherwise find it very hard to get into the credit market and access other forms of credit. And, you know, I think that's where certainly the microlending industry plays a very valuable part in helping consumers build a credit record at the bureau, which then opens up a whole lot of other opportunities for them. And so I spent a bit of time starting to work through the data from the National Credit Regulator to understand what was going on. And I guess this is just a little bit of the summary of what we found by looking at the NCR data. So the data that we are looking at here is from the NCR's quarterly consumer credit market report. The data is openly available on the NCR's website, so anyone can go and download the data set, and you can recreate these graphs for yourself. The data is there. So I also have the data sets, and if anyone ever wants to interrogate what we've done, feel absolutely free. So the first thing that we noticed, and the other thing that I just want to create a bit of context here, is that a lot of people were talking about the movement in the credit market in the relation to the last quarter. So you look at a lot of the stats coming out from the bureaus, they will often refer to the last quarter, or they will look at the stats year on year and showing shifts on that. And what I really wanted to do was to go back in time and saying, just take that proverbial big step back and say, what's really going on in the credit market? And so that's why I've taken data back to the beginning of 2015. Because that's when the new regulations were promulgated. Shortly after that, we had new pricing regulations come into play. And I wanted to see what was going on in the industry. So in this graph that I'm showing you here, the first thing you will notice is that up until the crisis in COVID, which if you can see the cursor, can you see it, the cursor? Maybe not.
No, sorry.
No, you can't. Okay, so what you're seeing is in the period of around 2020, when COVID happened, there's this big drop off. And so I was really looking at the periods pre-COVID and then the period after COVID. And I was really also trying to look at the data from the perspective of giving it sort of between 12 and 24 months after COVID, so that we weren't mixing that COVID period, which had some very big anomalies in that year, and trying to get a bit of a true before and after COVID view of the data. And what you'll see in those blue graphs is that the credit applications were sort of hovering per quarter between the sort of the 10 to 12 million credit applications. And that's for the whole industry across all credit products that were going to the credit bureau. That was showing the number of credit applications that people were applying for. And then when you look to the right towards that sort of last 15 months, you can see that the number of credit applications have risen very sharply over that period, to the extent of around 40% increase against the previous averages. And that really is talking to some of the strain that we're seeing in the market with inflation and the rise in interest rates. I think a lot of consumers are under pressure. So the demand for lending has definitely gone up. Then I noticed, and I was looking at the rejection rate, which is the red line in the graph. And what you'll see is that rejection rate was hovering around 50, maybe 55%, leading up to, just before the COVID. And then post-COVID, there was a very rapid rise in the rejection rates. And that rejection rate has continued to steadily increase, and it's now sitting at about 70%. So you've seen a substantial rise, but it's been a kind of a gradual rise over time, and not many people are focusing on the rejection rates in the stats. And the result of that is that the actual number of credit applications that are being approved, where credit's being granted, is the green line at the bottom. That has dropped by 18% from a pre and a post-COVID period. And so we've gone from around 4.9 million credit agreements granted per quarter down to about 4.0, just under 4 million credit agreements granted. And the impact of that on the average credit granted is that the average value of credit granted has increased by 55% from roughly 26,000 Rand per credit agreement up to 40,000 Rand per quarter. Now, my first instinct was, oh, wow, the value of credit being granted has been radically increased. But when in digging further into the data, there is a segment in the CCMR data which goes into the credit agreements by income group, and I had to go and sum all those up, and that then brought me to the next table of data, which was showing there that the increase in the average credit value was not coming from granting more credit to customers. It was coming from a reduction in lower income, in credit products granted to lower income consumers. So, what we need to understand is that, firstly, that affordability regulations have definitely resulted in a very pronounced correlation between income and the value of credit granted. So if you have 10 credit agreements granted of varying values of credit, and you go and take away the smallest credit agreements from that pool, let's say you get rid of 5 of those credit agreements of the lower value, the 5 agreements of the higher value will give you an automatic increase in average credit value, even though the value of credit you've granted to those 5 people hasn't effectively changed. And that's essentially what's happened in the market here, is that if you look at a pre-COVID level and you look at the number of credit agreements granted to consumers by these different income groups, you'll see that the consumers earning above 15,000 Rand have materially have returned to pre-COVID levels. If you look at what they've done over the last 2 years now, whereas all your other income groups are still anywhere between 17 and 34% less credit agreements granted than what they were pre-COVID. And so this rise that we're seeing in rejection rates is therefore coming primarily from these low income consumers who are being excluded from the credit market. And this then led me down to the question of asking why. And I only had my own experience to fall back on and say, why did we stop lending to first-time credit users? And the reason for that was because we're seeing that there are market forces that are forcing lenders to reduce their risk appetites. And so if I get into, well, what are those market forces? Firstly, if you look over the last 10 years, the cost of doing business has increased while the fees that lenders are able to charge have remained unchanged. So, just take into consideration things like our inflation rate over the last 10 years. The average inflation rate for 10 years up until the end of 2022 was 5.3%. If you compound that, that's a 67% increase in inflation. And that will come into everything from your wages for staff, through to the price you pay for your premises, through to everything else that you need to run your business. The Rand has depreciated by 50%, on average is 5.9% per year to the US dollar. How does that affect us? Well, if you use any kind of international based system, whether it be, using Google or using any other service that's provided by an international service provider, where we don't have those services in South Africa, you're going to be subject to the exchange rate pressures. And then on top of that, we've had a lot of regulatory compliance that's come in since 2015. And with 2015 came in the requirements for income validation, which was not something that lenders needed to do before. But there's a huge amount of process that goes into validating income. We've had Papier come in, DebiCheck has come in, and while that's not a regulatory thing, we have to use DebiCheck, and the price of DebiCheck essentially doubled from the old NATO cost of deductions. And then most recently, we've had FICA coming in and still is in the process of being implemented, which is requiring a lot of effort for people to be compliant with that, and costs involved in being compliant. So you've had a lot of these costs of your business going up while your fee revenue remains unchanged. And so how does a credit provider deal with the pressure on margin? Well, the only thing that they can really control is the amount of risk that they take on. And so what credit providers are doing is reducing the risk, which means that they are reducing the number of loans in their portfolio that tend to go bad, because they don't have the revenue to cover the percentage of bad loans. And so they're lending to lower risk consumers. And in the absence of that, the only other option that lenders really have is to effectively opt out of the formal credit market, which is maybe a little unpopular to say, but I do think that there has been a reasonably sharp rise in the number of credit providers who have not re-registered with the NCR, and are potentially operating still on high streets and the like, but are not registered with a credit regulator, and so therefore they're not facing any kind of scrutiny in their operation, and they're able to charge a different price or whatever they need to charge in order to make their business work. And so the unintended consequence of these outdated regulations is that it's effectively it's the middle class that are being disproportionately excluded from the formal credit markets. And, South Africa really has an extremely high Gini coefficient of around 63, 64. And so, this is just adding further pressure, because we're seeing over the last 3 years a very rapid exclusionary impact to low-income consumers being able to enter the formal credit markets. And worse to this is that these consumers are in essence being forced to access super high cost credit from unregulated loan sharks, because their need isn't going away. When people have an emergency need for credit, it doesn't go away. And so they're forced into the arms of the loan sharks. And it just does, to me personally, seem a little bit unfair that your wealthier people get to enjoy artificially low costs of credit, while the poorest in our country are actually being, structurally excluded from the formal credit markets. So, the question is like, so what are we doing about it? Well, there's a lot of discussion at the moment around looking at a pricing review, and if we consider how we've gone about this in the past, we've tried legal action, we've gone through looking at unit costs for credit providers in their ability and what they should or think they should be charging for credit. We're hoping to take a slightly different approach this time around. The first thing that we need to realize is that the government has the right to set pricing. Under the law, that's what they do. That's what they're allowed to do. But the market will respond to the pricing that has been set. And I think that we've got to realize that there's a cause and effect that is at play here. And what we're seeing in the market right now is not any company out there deliberately trying to exclude lower income consumers. They're responding to the market, or the market is responding to the pricing regulations that have been set. And this is the result. And, really what we need to realize as well is that we can go and do all the assessments that we want in the world to try and calculate what is the unit cost for granting credit. But the reality is there isn't a right level of rates and fees for South Africa. It's just a trade-off between the cost of credit and access to credit. And, in my past life, I was involved with a UK-based company. And, if you look at the UK, you had the companies there, their high-cost short-term credit could charge consumers up to a maximum of 100% per annum, which is far in excess of what South Africa charges. But the result there was that, almost the entire market had access to credit in the formal market. So, I'm not saying that that's what South Africa needs to do, but I'm just trying to illustrate the point is that the higher the price that people can charge, the more people will offer credit into those markets. So, I think we need to, what the approach that we're wanting to take now is just to work with policymakers to better articulate this relationship between pricing and access to credit. And so we are working with, potentially going to be working with a researcher to help us with a bit of research around this, to try and develop some kind of model that can help unpack and understand this, and help the regulator understand, or the policymakers understand that it's not for us to go and set the price, but it's not for the policymaker. It's for them to choose not what they want the price to be, but how broadly they want access to the formal credit markets to be when they're setting the price, because it's not something that we're going to try and fight with them on. It's their choice. But the choice is not about what pricing they're giving to us. The choice is for them to decide how many consumers in the market do they want to be able to access the formal credit market. And that is me. Are there any questions?
Thank you so much, Brett. I think this is a very interesting topic. And I think if I talk to all of our members, yesterday I saw some of our big members, last week I saw bigger members, smaller members, rates and fees is definitely a contentious issue. So like we always do our activity-based costing, when we will be reviewing the rates and fees, we will definitely work that in. But at this stage, as I can take it from your presentation, the people that are not benefiting from the rates and fees not being reviewed is actually the consumer, because they are being deprived from access to legal credit.
Correct.
Great. And that is actually the major concern. Jandre Botha actually said, thanks, Brett, that was very insightful. And I think it's very important to see it from a different point of view. So determining, what the rates will be will also determine the amount of access. We will also be doing a lot of information and a lot of research on this. But at this stage, Brett is providing the association and our members with a lot of insights of access to credit. And we are working with actual data from the National Credit Regulator. So this is not data that has been fabricated from somewhere. We are working with their statistics. Is there any questions with regards to the rates and fees, access to credit and financial inclusion from our members? Vera, nothing from you guys. Brenda, I see from the FSCA also said, thank you for the invitation and the presentation. So it's also good, to get their perspectives. But Brett, that is everything from our side. Thank you so much for the insights. As things unfold and develop, and as our research actually grows, we will also share it with our members. But thank you for the presentation, Brett.
Pleasure. Thanks, Leonie.
Great. So up next, we are welcoming back the NCR. Mboniseni, I believe that your sound has now been sorted out. We do welcome you back to the presentation, and let's maybe start from the top. Can you hear us, Mboniseni?
Thank you so much, Lenny. Am I audible now? I hope
Yes, you're audible. Thank you.
Okay, so I'm just gonna start from the beginning, if people don't mind, because it seems to not be heard. Thank you. As informed earlier, I am Mboniseni Makiva, a legal advisor with the National Credit Regulator within the Enforcement and Investigation Department. Feel free to ask any questions you can write on the message as I do the presentation. I'm going to take everybody through our investigation and enforcement process within the department. You also need to know the process. We are going to look at the trends that we have seen recently and discuss when do we take the enforcement action. That is the order today from us. So we get our powers from the National Credit Act in terms of Section 15 of the National Credit Act. That's where the regulator is authorized to conduct investigations. These investigations are conducted against any person, either a registrant or a non-registrant, if the information that is made available shows that these people are contravening or are in contravention of the Act. Lenny, you can please. You can still hear me.
Sorry, Mboniseni, we cannot hear you. Maybe if you can move a little bit closer to the microphone.
Okay, can you hear me now?
Yes, we can hear you now.
Okay, just gonna change the angle. Okay, as I was saying, these powers in terms of Section 15 of the National Credit Act empowers the National Credit Regulator to investigate any person either registered or not registered with the National Credit Regulator if there is information that they are in contravention of the Act. Also, in order to investigate all the registrants if there is information that they are not complying with their conditions of registration. Remember that in applying to become a registrant, there are specific conditions that need to be adhered to, that the registrant must sign. So once investigation is done, they are authorized, or we are authorized in terms of that Section 15, to refer any matters to the national, to the NCT, National Consumer Tribunal, or to issue compliance notices. And we are also authorized to cycle those matters outside the formal proceedings of the National Consumer Tribunal. So we are going to look at the structure of the Department of the Enforcement. So firstly, before looking at the structure, you might ask yourself as, who is investigated if you have not been investigated by the NCR before? So I'll just quickly check you through this. So the information that we follow, or the investigation, we only investigate if we have a reasonable suspicion that there is a contravention of the National Credit Act by a person or by a business. So this information might come from the complaints department. If a consumer lodges a formal complaint with the complaints department, the investigation will be conducted. If the information so contained in the complaint shows that there is a possible contravention of the National Credit Act. Secondly, the information may be received from the compliance department. If the compliance department conducts a compliance monitoring exercise and found serious contravention of the Act, and they believe this cannot be resolved by mere compliance notice, they can refer to the investigation department in order to conduct a formal investigation. And further, we can initiate an investigation if we receive an anonymous tip-off or we see information from social media that warrants an investigation. So with regard to anonymous tip-offs, you find that, for example, there are some unregistered credit providers who may threaten consumers and they do not want their information to be known. So they are allowed to then lodge anonymous complaints, and that information, should we decide that we are going to proceed with tribunal court, can then be made available to the tribunal, but we will not share the information. So the department is divided into two sub-departments. That is the investigation and enforcement. So if we look at the investigation, this is where the alleged conduct will be investigated by the inspectors. The inspectors are employed as inspectors within the National Credit Regulator. However, in order to investigate, they will formally be appointed by the CEO in terms of Section 25 of the Act. That authorizes them to conduct an investigation into a specific credit provider. So once they are appointed, then they will then be able to conduct the investigation. So you find that most credit providers do not understand why the inspector would just rock up in their premises. Remember that they do not need to make an appointment, because it has proven in the past that once an appointment is made, evidence goes missing. Remember that we are trying to find out if there are contravention of the Act or if there is any impact or suffering that the consumers encounter. And once an appointment is made, that evidence can disappear and there will be no recourse for consumers. So credit providers need to understand that if they stop an inspector who has presented them a certificate from the CEO from investigation, there can be a criminal case that can be opened by the National Credit Regulator. The case can be opened against the person who so stopped them, or the person in control, or the person who gave an instruction, even the director of such organization, if the inspectors are not allowed in order to conduct the investigation. In some cases, there will also be a warrant. I will explain where the warrant will come to. In that case, the inspector will come with members of the South African Police Service in order to conduct the investigation and search the premises in terms of the warrant. So the certificate is proof that that inspector is authorized to conduct that investigation. And if in doubt, you are welcome to contact the National Credit Regulator to confirm. Believe that with the relationship that is developed with MFSA, you can even contact people by MFSA who will be able to make quick contact with the National Credit Regulator to confirm the specific inspectors as being appointed by the CEO in order to conduct an investigation. They do, however, carry original certificates with a seal to show that they were appointed by the CEO to conduct an investigation. So once the inspector comes, they will request samples, because remember, if for some of the contravention, a consumer alleges that they were overcharged or credit, by sitting with a representative of the credit provider, it will not provide enough information in order to test whether the consumers are overcharged on the cost of credit or any instruments were taken from them, or that there were unlawful provisions in the credit agreements. So in order to check the contraventions or the extent of contraventions, the inspector will request files from the credit provider. We do ask that the credit providers provide those specific files. It's normally a number of 10 to say, can they provide us with a list of approved credit agreements for this period? And then we choose. And if those documents are not immediately available, arrangements can be made that the documents be available. Because once the documents or the samples are not made available, and it appears that we refer an application to the tribunal. Already it looks that the credit provider had something to promote. That's why they did not want to provide documents. So as I referred to the warrant, in a case where there's information, for example, that the credit provider is withholding consumer instruments, for example, identity documents, bank cards, or their SASSA cards, or any instrument that can be used as a means to secure payment, the National Credit Regulator will apply for a warrant. And that's why, if those documents are found, the person in control of the premises or the credit provider will be arrested, and there will be a criminal case that is registered. This is something that has happened a number of times. So once the inspector conducts this investigation and has assessed the documents, they then combine the information by doing, sorry about the slide, I'm too close, by completing an investigation report which details out the extent of conflict. So that investigation report will then be referred to a legal advisor. I'm going to take you back a bit to this screen. The legal advisor will then receive the investigation report. If a credit provider has been referred to the tribunal before, or have received compliance notice and asked for a copy of the investigation report, they would have seen this investigation report, which details out why there was an investigation. The investigation report will detail out what contraventions were found, the process that was followed to investigate, who was interviewed, and that their rights were read to them, and what is the extent of contravention. However, the legal advisor will receive this, will then make an assessment, and in terms of the evidence that is provided or the evidence that is lacking, they will then recommend what is the next step that should happen. So it's either going to be a compliance notice is necessary, or no, there are some serious contraventions of the National Credit Act, and an application needs to be referred to the National Consumer Tribunal. So referring the matter to the National Consumer Tribunal, that's when there will also be a decision, or a decision will be made as to whether it is a referral for prohibited conduct or it's a referral in order to cancel the registration of a registrant. On serious contraventions, there will always be a request that registration be cancelled and that person no longer trades as a credit provider. So I'll quickly take you through what is our current trends that we have observed. So I saw a question that said, what is the NCR doing about unregistered credit providers? So I'm going to start firstly with the trends that we have noticed about lapsed registration before going to that one. So remember that registration as a credit provider comes to an end at the 31st of July each year, and is a duty of the credit provider to ensure that these fees are paid by time. And if these renewal fees are not paid, there can be a penalty that the NCR registration department may install or may impose, and the finance department may impose, and that penalty will be payable in a number of days. However, remember, in terms of the National Credit Act, once registration lapses, it cannot be deferred. So if a registrant or a credit provider misses payment and does not pay penalty at the time of the, they are deemed to be no longer registered. And if they want to trade in terms of the National Credit Act, they are supposed to reapply to be considered as a credit provider. So once it's lapsed by operation of law, it cannot be revived. The only grace period that is available is the period that is granted in the penalty letter. So once registration lapses, as a credit provider, you may not extend any credit. So it goes to the extent where you become an unregistered credit provider. For those who are unfortunate to be referred to tribunal, they will see that if registration had lapsed, the NCR will then request or proceed in terms of prohibited conduct because they may not proceed for cancellation where registration is already lapsed because that credit provider is no longer a registrant in terms of the law. So it's treated as they are not registered. So this is also another trend that we have found, that there is a number of credit providers who are not registered in trading. However, remember, we can only act on information that is made available to us. And these are unregistered credit providers. They can only be detected by means of a scouting exercise if the area is scouted by the inspectors, or if a complaint is lodged, or if information is made available to the National Credit Regulator. So once we find out that there is a credit provider that is trading without being registered, we'll then proceed against that specific credit provider. Because remember, in terms of Section 40 sub of the Act, any credit agreement is deemed to be unlawful and void from the beginning. So, which means that whatever the credit provider had charged, while they are not registered, they are not entitled to that amount. So, in the recent two matters, I've put the case numbers. I did not include the name of the parties. So, in these two matters, the National Consumer Tribunal also confirmed the exact same thing, that if registration has lapsed or the party is not registered, they cannot grant credit. And irrespective of how many contradictions they have, they want the party proceeding or the National Credit Regulator to only proceed to ask the tribunal to declare all the credit agreements to be unlawful. So in answering the question, what is the NCR doing? We are currently proceeding. There is a number of them that we are requesting for those credit agreements to be declared unlawful. We are asking that the total cost of credit be paid back to the consumers. And we are asking that an administrative fine be granted against that specific credit provider. So if we refer to those specific matters, then the cases may show as 2021, 2022, but these are the matters that were decided by the National Consumer Tribunal in February 2024, where one party was granted an administrative fine of 250,000, and the second one, as you can see, there was a fine imposed of 800,000. So it is a very serious violation of the National Credit Act and is taken note of, and the NCR is currently attending to those, just to answer that question. So the other trend that is observed is the trend of reckless credit. So we found that credit is granted to consumers, and every time that credit is granted to consumers, the credit provider who has granted that credit does not know or have not seen the Consumer Credit Bureau report, has no knowledge of the information that is contained. Some of them found that they are handed to debt collectors, some of them are under debt review, and automatically any credit granted to a person who is under a debt administration order is reckless credit. And we found that some of the credit are granted without salary advices, bank statements, or declaration. So with some of the credit providers, certainly what they are doing, they are obtaining this document. So once as a credit provider, a credit bureau report is obtained and also the statements, it is an opportunity to conclude an affordability assessment in terms of Regulation 23A of the National Credit Act. However, we found that these documents are attached, but the information in them is not taken into consideration. The information, you found that the salary is not the same. And the information that is accepted is what the consumer gave, or is noted as what the consumer gave, but the information is clear in the bank statement and in the credit bureau report that could have been used in order to assess if that specific consumer can qualify for that specific loan. As is noted, there's also a specific defense in terms of Section 81.4, where the credit provider can say that this is not the information that the consumer provides. But remember, that specific defense to say this is the information the consumer provided. The credit provider is not limited to that information because there is a credit bureau report and there is a bank statement that they are supposed to go through, or a declaration by the consumer to say, this is the amount I make in a month that they are supposed to go through. So the other trends that we have found is that there is an overcharging of the consumer's cost of credit. This relates to service fees, interest, and we also found technically that some of the credit providers, they don't actually overcharge on interest, but they charge some unknown fees that are not disclosed in order to cover for the extra interest that they want. That is one of the trends that we found. Also, initiation fee, which we noted how is calculated, a deferred amount, which is not supposed to exceed 15% of the principal debt, and also service fee, that is 60 Rand per month, and regulation 44, make sure that you prorate on the date that the credit agreement was signed. So, as I said earlier, we talked about prohibited possession of consumer instruments. This is if you are found in possession of any ATM card, SASSA card, or a consumer identity document. There is no excuse to say that, but the consumer just left this, especially in a case where we found that is belonging to more than one consumer. There will be a criminal case that will be opened by the NCR in that case. So let's ensure that we do not use those methods in order to enforce the criminal agreements. So going forward, once this investigation is done or before proceeding, once it's assessed, as I said previously, I did inform about the compliance notice and how we may proceed. So the other important aspect that I feel that we need to get through is the issue of pleadings. So if it comes to a point where the NCR has decided that no, we are going to refer an application to the National Consumer Tribunal, either for prohibited conduct or for cancellation, our pleadings are sent via register because this is in compliance with the consumer rules, National Consumer Tribunal rules. However, what we do as the NCR is we do have contact details that are listed in the system. We send an email. When we send an email, we inform that according to the investigation that was conducted on a specific date, we have found contradictions and we are referring an application against you, the credit provider, in the National Consumer Tribunal, and for what reasons? Can they provide us with consent that if they may be sent to you via email? So some of our credit providers, unfortunately, they do believe that if they do not respond, we will not proceed. But remember, serving via registered post is approved. So the moment we receive the first notification, it says that the first notification was sent to the credit provider and we are allowed to proceed, and we may obtain before judgment. And as we've realized, most of us do receive those messages about the cost to be collected in the post office, and we do not consent to go to the post office. And that the tribunal and case law in the High Court has held before that is enough proof that first notification was sent and the person or the credit provider just did not collect the order. So let's just make sure that we work together. And remember that we are not against or after anybody. We do not have an intention to punish any credit provider. But what we want to ensure is that there is compliance with the Act, there is compliance with the regulations, and that there is relief or some form of relief to the consumers, whether they know that they've been wronged or not. So we're not coming against anybody. The better we work together, this is where the issue of settlement agreement and consent orders come to, because if even though we proceeded and we're asking for the National Consumer Tribunal to grant a fine of R1 million, we can still negotiate, we can still settle, and we can still agree as to what is it that the credit provider should do in order to correct the process. And also being part of MFSA, is even better, because if wrongs are found and they are referred back to the organization, then that can be corrected. So just looking at some of the things or the orders that we request the National Consumer Tribunal to grant us when we refer this application. We request that it be declared that the credit provider or the person involved has conducted themselves in a manner that is inconsistent with the Act by that doing prohibited conduct, and that in case of reckless credit, we request that the agreements be certified and the proof of credit be paid back to the consumers. So compliance is better because paying back, nobody has a budget to pay back. In case of serious violations of the Act, that's where we request that cancellation of registration, because we cannot allow the specific credit provider to continue conducting themselves in that manner. Further, we request that then an interdict be granted. With an interdict, remember that once you are interdicted, if you conduct yourself in the similar manner, you may be arrested. So that's why we request an interdict, because remember, our main issue with referring to the consumer tribunal is we need to protect the consumer who have been overturned. We may request an audit that the person appoints an auditor, or the trade provider appoints an auditor. The auditor will then disclose through an audit the extent of contravention, or who are the consumers that need to be paid back. We may request refunds and write-offs, and that if there are any goods that belong to the consumers that have been taken, that they be returned to the consumers. Further, we may request an administrative fine. A criminal case is where we request an interdict. If there's no compliance, then we can open a criminal case. That is that from my side. I think there will be some questions.
Thank you so much to the NCR, Mbusine and Takalani. We really do appreciate it. I'm just going to have one question we have here. And Mbusine, perhaps you can clarify with regards to sending the documents via email, how can the registrants give permission for that process to be established?
Okay, thank you. So what we do before we proceed, we check in within our registration department, what is the email that was registered when a registrant applied for registration. Secondly, when an interview is conducted during the investigation, remember that there is the 134, which is a statement of rights. So if a credit provider signs a statement to say that their rights were then read to them, they are able to then also provide the updated details. So ensure that we send these emails to say that from both emails, even if it's 5 emails we found, to say that we are requesting that you consent to electronic service. You may also serve us electronically. If they agree that we serve them electronically, then that is done immediately, which also gives them an opportunity, if they need to consult, that they may consult in action.
Okay, perfect. Thank you so much. So in essence, they have to ensure that their contact details are updated. And then in that registrant info update form, they can indicate that they want to be serviced electronically.
That is correct.
Okay, great. Thank you so much. I don't see any additional questions. If there are any, you are welcome to send it through to the MFSA office, and we will ask the NTR team to provide us some answers in writing. I think, Mbusine, thank you so much for just clarifying the investigations process again. We are definitely focusing on ensuring that the registrants are updating the contact details, and we will have a process in place for our members this year specifically to update the details where necessary. So I think it just emphasizes the importance once again of compliance. So thank you so much to the NCR team. We really do appreciate your support and all of the assistance that you provide the registrants with.
Thank you so much.
Thank you so much. So thank you to everyone. I see we are on 121 attendance still. So thank you for those who waited until the very end. I did post a link in the chat box for you to complete our survey. Your feedback really is important to us, and we really do look at that when we structure these workshops. And then just once again, a big thank you to our sponsors for supporting the MFSA with our workshops and making it possible for our members. So that is it, ladies and gentlemen. Once again, thank you for your time. Have a lovely afternoon. Bye-bye.